key word we keep hearing is the word uncertainty.
You still have a lot of uncertainty out there, even after April 2nd.
There is some wait and see out there.
As we get more clarity, I think markets will be able to get on with whatever is the destination.
The next couple of months is going to be a really rocky road.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday with equities attempting to hold on to recent gains as President Trump teases a lighter touch on tariffs.
Well, I may give a lot of countries breaks, but it's reciprocal. But we might be even nicer than that. We may take less than what they're charging because they've charged us so much. I don't think they could take it. In other words, they've charged us so much that I'm embarrassed to charge them what they've charged us.
Negotiations ramping up in Washington. The EU trade chief is arriving to meet with the Commerce Secretary Howard Lutnick, kicking off a flurry of talks in the run-up to April 2nd, when Trump plans to reveal so-called reciprocal tariffs. Later on this morning, another read on how consumers are feeling about next week's deadline. Consumer confidence due at 10 a.m. Eastern Time.
Which is going to be really important to understand just how much the consumer is pulling back or saying that they're pulling back at a time when the other economic metrics that are coming out of the United States are actually turning upward, or actually pretty positive. So if you see this soft data that continuing to diverge, it'll keep that concern still in markets. If not, watch it go to the moon and people pile back into the exceptionalism story.
We're just over a week away from this Liberation Day, April 2nd, these tariffs. And what I gained from President Trump yesterday is that he seems to be in the mood for making deals and he seems to be flexible. 3 key meetings. We have the European Union trade chief coming to town, meeting with Jameson Greer and Howard Lutnick. You have a U.S. delegation going to India. They're looking for exemptions. And then Jameson Greer is supposed to get on the phone with his Chinese counterpart this week. Potentially, we could see deals done before April 2nd.
You could really sense the whole market just sort of exhaled in yesterday's session. This is what we heard from the likes of Evercore and Julian Emmanuel. The bull still lives as Tariff Liberation Day approaches.
Yeah, and it wasn't just Julian Emmanuel. It was also people from JPMorgan and Morgan Stanley that came out and said, well, probably has been a bottoming out that we've seen in sentiment. JPMorgan came out and said the risk of another violent unwind should be low in the short term. It's raising questions about whether we have already rebalanced this sort of momentum unwind, whether people's sort of foray into Europe might be maybe a little exhausted, and people are starting to come back to the
I caution some people on just basically wish casting Liberation Day light, though, because one thing Trump did say yesterday was that sectoral tariffs are still going to be coming, whether it's the automobile industry, pharmaceuticals, semiconductors. He said he will be in the next few days, either before or after April 2nd, those tariffs will also be coming into play.
We've said it repeatedly on this program, the situation is fluid, very fluid. One single name to look at every single morning at the moment, Tesla. Tesla's had a nice bounce off the lows, a really nice bounce off the lows of almost 25%. Tesla this morning down just a touch. We're down 1/3%. The latest sales numbers out of Europe, once again, a big disappointment.
Down 40%, even as some of the competitors are seeing increases to their sales. I'm looking at not just Chinese manufacturers, but also Renault, as well as Citroën, who have these cheaper models of electric vehicles that are selling at a significant pace. It raises a question. First of all, do we now care about deliveries for Tesla? And that seems to be a question for some of the people who are bearish in this name. And second of all, how much does the rhetoric out of the White House indicate real concern on the part of Elon Musk and Donald Trump on some of these protests that we're seeing around the world?
That stock is down by 0.4%. Tom Narayan of RBC joining us later on the program to break down some of the challenges that company faces. For the broader market, equities just a touch softer. We're down 0.1%. Coming up this hour on this program, Emily Bowersock-Hill of Bowersock Capital Partners with stocks on a 2-day winning streak coming into Tuesday. Alex Nowrasteh of the Cato Institute as trade negotiations kick off in Washington. And Claudio Irigoyen of Bank of America after downgrading his global growth forecast. We begin this hour with stocks steady after one of their best days of the year so far. Emily Bowersock-Hill of Bowersock Capital Partners writing, we have shifted from a moderately bullish outlook to a neutral/bearish viewpoint. It is too early to add back to US equities. Emily joins us now for more. Emily, welcome back to the program. It's been too long. Let's just get to that final point. Why do you believe it's too early to add back to US equities?
Well, I think we had a really good earnings season and saw 18% growth in S&P 500 earnings, year over year. But the guidance that many companies issued raised red flags. And I think that guidance was really not taking tariffs into account. And so the projections for the S&P 500 over the next earnings season at about 11%, frankly, it's a pre-tariff number. So our concern is that the American consumer and American businesses are expressing, serious problems with confidence and with expansion plans, et cetera. And while a lot of times consumer sentiment does not necessarily translate into consumer spending, our concern is that this time it will. Now, I would say that we're neutral to slightly bearish. So I imagine the S&P 500 ending the year at about 6,000. But I think there's a lot of volatility ahead.
Just to pick up on your first point, which parts of the equity market do you think are more vulnerable to that viewpoint? The airlines did come out and say things were pretty bad through the middle of February in the first quarter. The retailers have given us some pretty weak guidance as well. Where do you think is more vulnerable, given the lack of guidance you believe we haven't had?
Well, airlines, Walmart even, places that people go when, they're not exactly big spenders. And as you likely know, about 50% of our consumer spending right now comes from the top 10%. 10 years ago, that was 36%. And I mean top 10% in net worth and income. So I think it wouldn't take a lot if those higher end consumers started to cut back. That would have a significant effect on consumer demand.
Emily, just to put this into perspective, you turned neutral to moderately bearish late last year and early this year before the inauguration of President Trump, before there was a lot of the discussion around tariffs. Can you talk about why and how much of this was just what we saw in the economy versus the overhang of tariff concerns?
To be clear, we turned bearish in the first 2 to 3 weeks of this administration. And, I think it's important. For the most part, politics do not affect markets, or at least haven't in this country. But I would point to what we saw in Turkey over the last week. And so I think that's the test case of when politics can start bleeding into market performance. And I think the kind of uncertainty that's being created by the chaotic tariff policy is something that has to give anyone pause. And quite frankly, we're in the process of destabilizing a world order that has redounded to the U.S.'s benefit for 80 years. If we break it down and look at, country by country, India, Brazil run a very significant trade deficit. There's certainly an argument that there should be some fairness there. But on balance, we have benefited. Look at our economy over the last 80 years. And I think what we're doing is going in and destabilizing a system that has been very good for Americans and very good for our stock market.
One of the biggest surprises this year has been that the United States doesn't seem to be at least the stock market winner so far of the tariff discussion, and the rest of the world seems to have benefited more. And I wonder what the logic is behind that. Is it just simply some of the fiscal plans, or is it a complete 180 in terms of a belief that if the U.S. puts on tariffs, the U.S. gets hurt more than the rest of the world?
Well, frankly, I think we're engaging in, and by the way, I have a PhD in history and did my dissertation on the 1930s. So I have a slightly different cast to this whole thing. But frankly, the Trump administration argues that they want to run the country like a business, prize growth and efficiency. And what we're effectively doing is in 2 months, destroying our brand. This is reminding me of, Budweiser and the transgender ad. And overnight, Bud Light went from the #1 selling beer, to 3 or 4 or whatever it is now. What did we get for that brand destruction? And so, I think one of the reasons that we're seeing capital leave the U.S. and that we're seeing a resurgence in European stocks is effectively what we're doing from a power politics perspective is we are creating alliances against us. Europe, look what Germany just did. They're putting €1 trillion into their economic system. They're all going to have their own defense spending infrastructure. And remember, it was in the 1960s, that was part of the nuclear non-proliferation deal, that the Europeans were not going to have nuclear weapons. Now we're going to see a resurgence in Europe, both with the rebuilding of Ukraine and with the need for them to all essentially have their own defense forces.
Emily, I noticed
I think there's a reason for it.
You're looking elsewhere, and right now, 2 months into this administration, really only have one pillar of the three that the Trump administration says that they want to enact: tariffs, deregulation, and the extension of tax cuts. When would you want to get back into U.S. stocks?
So the reason that we're neutral to slightly bearish rather than bearish, because if you heard everything I've said in the last 2 to 3 minutes, you would think that I was a bear. But there are some significant countervailing forces, and I am going to answer your question, that I think could save the bull market, okay? One of those is that our economic fundamentals are still strong, right? Number two, my firm's thesis that we're in the middle of a post-pandemic roaring 20s driven by AI productivity boost and innovations in other sectors, including the green energy transition, that's a very powerful force for growth, and that could save the bull market. And, third of all, our economy proved very resilient during a period of rising interest rates. No one thought it would do as well as it has. And it's very possible that it'll sail right through all of this political chaos. But the final thing is, I do think deregulation and tax cuts will flow through into corporate profits. The question is, and especially deregulation, the question is, can that happen soon enough? And how much of an impact is it going to have? What we're really talking about doing, or what the Republicans are talking about doing, is extending tax cuts that are already in place. And it's going to be a $4 trillion plus tax bill. So I think if they can pull that off, that's another of the four factors that would save this bull market.
It's a good point, Emily. It's good to see you and great to catch up again. Emily Bowersock,
good to see you,
of Bowersock Capital Partners. A cautious outlook, but ultimately one where equities could continue climbing. We have found a bear. Max Kettner, HSBC, with another big change over at HSBC out of London. We're now underweight the US across the board. That's IG credit, high yield credit, and equities too. It's no longer about Goldilocks, but whether the sentiment shock of the over the last couple of months will spill over into more US hard data weakness. Uncertainty is high, but tariff noise is likely to extend beyond April 2nd.
Yeah, from ultimate Goldilocks, super Goldilocks, to pain and no gain, and this sort of shifts in the near term. I would love to speak to him over longer term what this means. But right now, this is what we're hearing from a lot of people. Why accept the risk premium associated with tariff noise, which we've been getting?
Equities a little bit softer this morning. We're down by 0.2% on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Senior foreign officials and major tech companies are pushing the Trump administration to rethink its chip strategy. Sources tell us that companies like NVIDIA and Oracle are pushing to repeal a rule that restricts exports of AI processors to most nations. Elsewhere, Hyundai has announced plans to invest almost $6 billion in American manufacturing. That includes a new steel plant in Louisiana. Hyundai also announced plans to spend about $21 billion through 2028 to increase U.S. production, confirming our earlier reporting. President Trump said that it's a clear signal that tariffs work. The Atlantic's top editor says that he was added to a text group where top U.S. officials discussed plans to bomb Houthi targets. Jeffrey Goldberg says that he received a connection request via the encrypted messaging service Signal from National Security Advisor Michael Waltz. The White House acknowledged the breach, but downplayed its significance. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later on in the hour. Up next on the program, the countdown to April 2nd.
That'll be reciprocal tariffs. But we may take less than what they're charging because they've charged us so much. I'm embarrassed to charge them what they've charged us, but it'll be substantial. And you'll be hearing about that on April 2nd.
That conversation just around the corner. We'll be catching up with Alex Nowrasteh of the Cato Institute in just a moment. From New York City, good morning. Equity futures here are a little bit softer. We're down by 0.1% on the S&P after a decent day of gains. On the Nasdaq, we're down by 0.2%. The Russell underperforming here, negative by 0.4%. Yesterday, for a moment, a collective sigh of relief on Wall Street. Max Kettner of HSBC is not buying it. Out with a note just moments ago, underweight the US across the board. It's no longer about Goldilocks, but whether the sentiment shock will spill over into more US hard data weakness. Uncertainty is high, and that tariff noise, he says, is likely to extend beyond April 2nd. Under surveillance this morning, the countdown to April 2nd.
It's going to be everything, but not all tariffs are included that day. For instance, we'll do some. As you know, we have already done steel and aluminum, and that's at a 25% level. And we are going to be doing automobiles, and then April 2nd comes. That'll be reciprocal tariffs. But we may take less than what they're charging because they've charged us so much. I'm embarrassed to charge them what they've charged us, but it'll be substantial. And you'll be hearing about that on April 2nd.
So here's the latest this morning. Countries rushing to offer concessions in the run-up to President Trump's April 2nd tariff deadline. The EU trade chief is heading to Washington today for a high-stakes meeting with top economic advisors. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the programme. What's in play today for these trade chiefs?
Well, John, we know that President Trump is looking at those countries that have no tariffs, low tariffs, or run a trade surplus with the U.S. as potentially being up for these exclusions. But also, we know that he's considering whether or not countries have been cooperative or combative when it comes to these negotiations. Today, the EU trade chief meeting with Commerce Secretary Howard Lutnick and the USTR Jamieson Greer. There is heightened momentum to this meeting after President Trump yesterday said that he was going to move to impose auto tariffs in a matter of days. That, of course, is going to heighten these talks going forward. Our reporting indicating that Bloomberg News reporting indicating that at the moment, the EU could be holding off on some immediate retaliation in favor of kicking it to later that month in hopes of making progress when it comes to these talks. There's a slew of other ongoing negotiations happening this week. For example, an American delegation just touched down in India, and we also know that the USTR Jamieson Greer will hold a talk with his Chinese counterpart at some point this week. John, that is going to also have heightened pressure against it after President Trump yesterday moved to impose a 25% tariff on any country that imports Venezuelan oil or gas. We know that will hit China particularly hard as a top importer of Venezuelan crude and already has that 20% levy imposed on it across the board.
Tyler, when it comes to these countries, they're really rushing to try to strike a deal before April 2nd. Can you walk us through some of the sequencing potentially the president was talking about yesterday when it comes to reciprocal versus sectoral tariffs?
Right. So, Annmarie, we know those reciprocal tariffs are now up for some potential country exclusions. And then he sort of laid out a timeline, if I could call it. He said when it comes to auto tariffs, those could be coming in a matter of days. He said when it comes to pharmaceutical tariffs, those could be coming in the very near future. And then when it comes to chips and lumber tariffs, those could be coming down the road. So it seems that those auto tariffs are indeed next on deck, and those will particularly hit the European Union hard. We are starting to glean some details about what concessions could look like. And that is why we have to keep in mind that these reciprocal tariffs are taking into account not just tariff barriers, but also those non-tariff barriers. Take, for example, Annmarie, Bloomberg News reporting that the United Kingdom is considering rolling back potentially or abolishing its digital services tax. That would be a big win for this White House after the first Trump term failed to see our European allies roll back their DSTs. So that could be something on the table when we are talking about potential concessions looking ahead to next week.
Hey, Tyler, good to hear from you. As always, more from Tyler Kendall later on in the programme. They're the kind of things we want to hear. We'd like to hear more of that a little bit later between the European Union and the United States. We'll see. But ultimately, this is the point that Max Kettner of HSBC is making this morning. This uncertainty is likely to persist.
It's a feature, not a bug of this administration. And what Tyler really was showing there is that Trump's coming in with maximalist demands, whether it's on VAT, whether it's on digital service tax, saying he wants concessions on all of these issues. And what do you see today? The European Trade Commission coming to Washington, D.C. to try to strike a deal before he comes out with his plan on April 2nd.
Here's one take from Alex Nowrasteh of the Cato Institute, writing, "We don't know the scope yet, and the uncertainty adds another layer of danger, but it would be a mistake for other countries to reciprocate with higher tariffs." Alex joins us now for more. Alex, welcome to the programme. Do you think those countries are going to take your advice?
Probably not. They haven't taken it so far, but I do think it's hopeful that the Europeans are probably going to delay any kind of reciprocal tariffs for at least a period of time. I mean, tariffs do an enormous amount of harm both to the country that exports, but primarily to the country that imports this. I mean, it's basically a tax. So we have a situation where the United States is threatening to harm their own economies, and I think it would be a mistake for Europe and these other countries to do the same.
What kind of exemptions can we see from the Europeans? Because the FT at one point was talking about weeks ago that they were going to lower the barrier when it comes to American autos going into the EU, and Trump has signaled that quite a few times from the Oval Office.
Yeah, I think that's primarily the big one is the autos, but also on the example of the digital services tax. I mean, that's been a big point of disagreement between the U.S. and Europe for years now. That's one where there could be some kind of concessions, but it's just important that these countries not overreact by going to the wall, by going to the maximum type of reciprocal tariffs. I mean, these are very damaging to everybody involved. So I just hope that everybody remains sober in responding to Trump's tariff threats and the actual imposition of these tariffs.
So we have the reciprocal tariffs on April 2nd, and then he's talking about sectoral tariffs as well. How are you thinking about both of these?
Well, I'm thinking it's going to do massive damage to the U.S. economy, especially to firms exposed to international trade, of course, in substantial ways, but also with supply chains raging across several different countries. I mean, supply chains make the effective tariffs even more devastating if a product in its intermediate phase of production goes across borders several different times. So this magnifies the potential damage for the U.S. economy and the global economy as a whole. I mean, it's important to remember most of the U.S. trade is with other developed countries, with Europe, with Canada, with Mexico, and countries that are close to us. So this type of damage, especially in North America, but also with our European allies, could be quite devastating for high-end manufacturers and other types of highly profitable American firms.
A lot of people would agree with some of the goals that President Trump is going for, including bringing manufacturing back to the United States, improving flow of trade, creating more domestic production of certain, particularly national security-related items. What do you think is a better way to do it?
I think a better way to do it would be to lower trade barriers to make it more attractive for firms to locate in the United States and take advantage of supply chains across the board. Also, I think pursuing tax reform under the extension of the Tax Cuts and Jobs Act, which is the big tax news this year domestically, making those rates lower, making the base broadening the base, as well as a substantial deregulation. We have seen the Trump administration pursue deregulation in terms of energy, some in healthcare, some in AI, and some positive tax moves, such as getting out of the OECD tax treaty. So I think pursuing those types of responsible policies, as well as trying to get the deficit under control, would do a lot more to bring a lot of American firms, to reshore American production, but also to convince a lot of foreign companies to bring firms over to the United States and increase production here. I mean, one thing to also recognize, right, is every tariff, a tax on trade into the U.S. is also a tax on exports. And if this administration wants to boost exports, wants to reduce the trade deficit, which really doesn't matter anyway as a number, they should not be leveling a tax on imports, because that will just reverberate to an effective tax on exports.
Just quickly, Alex, do you think that there's a chance that all of these negotiations will ultimately lead to a lower tariff rate and actually more closer trading ties with certain nations?
Let's just say that I wouldn't bet on that, but if that happens, I will certainly come back on here and eat my hat.
Alex, appreciate your time, sir, as always. We know what you'd like to see. Alex Nowrasteh of the Cato Institute there on the trade situation. I think in an ideal world, they would be negotiating lower tariffs across the board, and hopefully that's the start of something later on this morning down in Washington, D.C., but a lot of people at the moment concluding that's unlikely.
But also, if that's the start of a conversation, not the end, that just means uncertainty will be prevalent in this market for months to come, because he's going to constantly be in this flexibility negotiating mode when it comes to how he's dealing with trade partners.
If you're just joining us, welcome to the programme. Expecting some negotiations later in Washington, D.C. between the EU and the United States. The EU trade chief sitting down with the Commerce Secretary, Howard Lutnick. And the equity market at the moment just about unchanged in the S&P 500. No drama. Over in China, there might be some. We're going to catch up with Shehzad Qazi of the China Beige as global CEOs gather for the China Development Forum. From New York City this morning, good morning to you all. You're watching Bloomberg Surveillance. Equities just about unchanged on the S&P 500, attempting to build on yesterday's gains. A two-day winning streak on the S&P, coming off the back of a mild week of gains. The gains yesterday unlocked by a more targeted approach from the President of the United States, potentially regarding trade. Certainly teased a softer approach in some of the comments the President made in yesterday's session. In the bond market, that unlocked higher bond yields across the curve on a 2-year, 10-year and 30-year, and they keep climbing. Up another 2 basis points on the session on a 10-year, 435.77. At the front end of the curve, up by 2 basis points to 4.05%. With that additional dollar strength, check out the FX market. Euro dollar at the moment trying to buck the trend. After 4 days of euro weakness, euro dollar pushing out some strength here, Lisa. Euro dollar 108.18.
Yeah, but still kind of trading in and around this range. It has been this sort of ongoing question about whether we've exhausted the momentum trade that had been the United States, that unwound into Europe. And that's what some people are saying is possibly some of what we're seeing right now across asset classes.
Could be a big test for the data over in Europe in the months to come, depending on how they respond to trade and the fact that it's going to take a while to deploy some of that fiscal loosening that we've seen out of Germany in the past few weeks. On our radar this morning, The Atlantic's editor-in-chief saying he was added to a text group where top US officials discussed detailed plans to bomb Houthi targets in Yemen. The incident prompting fresh national security concerns.
Obviously, this is incredibly concerning. Obviously, this was very clumsy. One thing I will say, there has been very little interest in what has been going on in the Red Sea for more than a year, even though we have some 40,000 U.S. troops in the Middle East region. Yesterday, if you looked at the Google trends over Houthis, they spiked. It took this story about incompetence, about adding a journalist to a text exchange for people in the media to start actually being educated about what's been going on when it comes to the Red Sea.
There are a lot of aspects of this. You can look at this from a million different angles. A question about what kind of security, that they probably shouldn't have been using Signal to talk about these things, but rather a secure room. In the framework of the negotiations that are ongoing in Washington, D.C. right now with Europe, it highlights the increasing tensions with real animosity in the White House, in the cabinet, where people are saying they need to pay their way and we're bailing them out again. And that was made transparent in some of these texts, which I think will complicate some of the discussions in Washington.
I agree with you. Just to build on that, I think we've got a decent idea of what was driving that decision. The kind of debate that was taking place behind closed doors regarding it, that trade channel was far more important for the Europeans than it is for US trade. And there was a belief, particularly from the Vice President, according to these reports, that he was upset about bailing out the Europeans again. But what really drove the decision? They were also equally as upset that the former administration hadn't provided a deterrence in the region. And this was an example, as far as they were concerned, that they were willing and able to do something about it.
Even though they have been very annoyed with Europe, and actually what I was reading there in text is basically the readout I have gotten from people about where J.D. Vance stands, the vice president, when it comes to Europe. He's probably one of the most isolationist part of that group. But at the end of the day, this group came together, and for collective security of global shipping, they were willing to put American lives at risk.
There's going to be a lot of questions about what happened there and how secure that data will be going forward from here. And on that relationship between the United States and Europe, check this out. Trade talks ramping up in Washington as countries rush to offer concessions ahead of April 2nd. The EU's trade chief set to meet with Commerce Secretary Howard Lutnick and Trade Representative Jameson Greer a little bit later on today.
We should note that this is yet another meeting that Howard Lutnick and Jameson Greer is having with their European counterpart. It was just a few weeks ago Howard Lutnick was on this program, remember? And Donald Trump came out and talked about 200% tariffs on European wine, champagne, and cheese. And Howard Lutnick said, I'm going to get on the call with my European counterpart. So these talks have been taking place. The reason why the talk today is so important, because we're a week out from April 2nd.
You can have a series of talks through the next 24 hours down in Washington, not just with the Europeans, but also with an Indian delegation as well. So look out for some headlines regarding that story. Check this out from China. Alibaba's chairman warning of a potential bubble forming an AI data center construction. The executive saying the rush to build server bases from the US to Asia is starting to look indiscriminate, and many projects are built without clear customers in mind.
There are a lot of ways to take this. One of them could be that Alibaba is coming out in a 1-2 punch after yesterday saying that they had come up with an AI program that also used AMD as well as Chinese-made chips. It also was efficient, kind of like the DeepSeek moment. So, hey, look at us in China. We're coming up with all sorts of technology that's going to render your $1 billion of investments completely obsolete. On the flip side, it leans into concerns that a lot of people have been saying, including the fact that Microsoft reportedly backed away from some of its investments. So it sort of builds on concerns that already are out there. I will just say this is going to be the centerpiece of so much discussion down the line. Who is getting the upper hand and what tactics are the Chinese, U.S., concerns or competition when it comes to AI? What are the tactics that are being deployed?
Let's keep it on China. China's saying it is preparing for, quote, shocks that exceed expectations as it braces for more tariffs next week. Officials telling a gathering of global business leaders, including Apple's Tim Cook, the country should be opening up markets and sharing resources. Shehzad Qazi of China Beige Book joins us now for more. Shehzad, good to see you, sir.
Thanks.
This feels like a new moment for China, a new phase for growth. There's a phrase that we use continually on this program, that the United States innovates, Europe regulates, China imitates. That last point on China no longer feels valid. It feels like China is moving into a different phase. How would you describe that phase now?
Yeah, I don't think that's been true for a while, because they've gone from just imitating to often, I think, being the place where a lot of the design is taking place, a lot of clearly the innovation is taking place. And I think it's taken that for policymakers out here in the U.S. to wake up and realize that business as usual can't carry on with China anymore.
If China no longer needs Western innovation in the same way it did many, many years ago, what does that mean for Western participation in Chinese growth? Corporate participation from the West into China going forward from here?
So they may not need it, but they certainly still welcome it and still would like to have it. On the other hand, of course, they rely on us as a market. So regardless of what they're doing on the innovation front, they need a place oftentimes to sell. And nobody's a bigger buyer in many ways than the U.S.
At the same time, there's an argument being made by a lot of U.S. companies that they want access to the innovation that's coming out of China. And we hear this from the likes of NVIDIA, that obviously has a vested interest, but we're also hearing this from the likes of FedEx and Boeing and Cargill and all these other companies that also do business in China. How valid are those discussions? I mean, how much are they operating as somewhat of the diplomats right now to the U.S. government?
Yeah, I think, industry is going to make all sorts of arguments, in order to maintain their access in China and have it be unfettered. Whether it's this or whether they need the market or they need the revenue in order to do more R&D. These are, I think, a lot of this is just industry pushback on policies that, of course, don't work for them.
It's important to understand the economic context to this in China, and that's one thing that the Chinese book does so well, the China Beige book. I'm curious how successful they have been with the recent rounds of stimulus in truly boosting consumption, which has been the key cudgel that's kind of gotten in the way of their being able to really recover.
So it's been very piecemeal, but I think a big chunk of that is because for now, they don't feel like they need to go harder. Now, once the tariffs hit, once the economy perhaps sees the impact of that, then they may get a little bit more aggressive on their consumer stimulus. But for now, they've done some trade-in programs. They've seen some benefits of that, and they've decided to live with the short boost to growth.
But some tariffs have already been hit. There's 20% additional tariffs on Chinese imports. This evening, this week, we'll have a call, Jameson Greer and his counterpart. What do you expect the negotiations to look like between Washington and Beijing?
I think, this immediate call may be just Beijing also looking for a lot of information, because there's so much confusion, including within the Communist Party, right to the top in terms of just what the tariff policy is going to look like. From the U.S. side, of course, they're very interested in saying you need to make good on your phase one agreements to begin with. And then perhaps there's some discussion of what could eventually look like a phase two.
Well, phase one, shouldn't China have been doing that before Trump came into office?
Absolutely. I mean, in many ways, phase one was a total disaster from a U.S. standpoint. So making them go back and purchase all those commodities, I'm not sure how you pull that off. But that, I think, should warn you that any major deal with China is probably not workable at this time.
How workable are secondary tariffs? I'm sure you saw the headlines in the last 24 hours. How workable is that going to be?
Yeah, it's going to be hard. I mean, how do you go around, hitting them, and then, what do you do with countries that are your allies again versus a China or somebody else? So it's a tool. We'll see how effective it is.
So help me understand this. If you buy Venezuelan crude from here, you get an additional tariff from the United States on anything you're trying to purchase, or rather anything the U.S. is trying to purchase from you.
Yeah, it's an additional called secondary tariffs, which I've never seen secondary tariffs done with tariffs. I've only seen secondary sanctions. Say a secondary sanction, if you're Iranian crude, you go after the banks that are involved or the teapot that's involved in buying the crude. Now they're doing it with tariffs. There was nuance, though, to this executive order. The United States seems to have a little bit of freedom, and depending on what country they decide to put that secondary tariff on.
So China's a buyer of Venezuelan crude.
So China will be one of them, I'm sure.
And with that in mind, we're going to go from 10 to 20% to what?
To 45 or 50% if we actually start doing that. Yeah. But keep in mind, China's been buying Iranian oil this whole time. What have we done about that?
It's very hard to enforce. That's the problem, right? Until you decide to go after these ships, it's very challenging to enforce.
Shehzad, good to see you. As always, great to catch up to break it down. Thank you, sir. Shehzad Qazi there of the China Beige book. Secondary tariffs is now something we've all got to grapple with. Are they actually going to enforce this? Will they actually move forward with this? Is this a threat? Because when it comes to China, never mind 10, never mind 20, you could have something closer to 50% across the board.
I guess it depends how bad China wants that type of Venezuelan crude, which is hard to get. It's not, easily accessible all over the world. What I would say is when it comes to things like secondary tariffs, which is new, secondary sanctions, it's the enforcement that is so challenging. We have had basically all of Iranian crude sanctioned throughout the entire Biden administration, yet they were shipping how much? 1 million barrels, basically, and, basically getting up their FX reserves because of it, because they weren't enforced.
Josh Lipsky over at the Atlantic Council had this interesting observation where he said that President Trump has been very critical of sanctions in the past and that will lead to de-dollarization. So it seems as though the idea of secondary tariffs is replacing sanctions as sort of the tool of choice. A lot of questions about enforcement. It indicates, though, the desire to have a similar effect, at least with a different tool.
Something the Treasury Secretary has said as well, Scott Bessent, not a big fan of the sanctions regime, thinks it's done the same thing to the US dollar, and we'll see if this is a new front for the trade war. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Airlines may seek legal action against Heathrow Airport after Friday's unprecedented shutdown. The Guardian reported that a body representing more than 90 carriers could take the airport to court if a settlement over the cost from the hours-long closure is not settled. Elsewhere, India is planning to seek an exemption from President Trump's reciprocal tariffs. Trump say that New Delhi officials will make the case when the two sides meet for bilateral trade talks today. India has already taken steps to appease the U.S. president. That includes lowering imported taxes on certain goods. President Trump says that he would welcome the Kansas City Chiefs to the White House, an unusual visit by this year's Super Bowl losing team. Trump said the visit would be to celebrate the Chiefs' 2020 victory, which they missed due to COVID. This year's Super Bowl champs, the Philadelphia Eagles, are planning a White House visit on April 28th. And that's your brief, John.
Danny, thank you. Participation trophy is not something I expect from conservatives. It's got to be winners and losers here, Bramo. Not everyone gets a prize.
Why just conservatives? I think there are a lot of people who think that everyone should be, a winner or a loser, and that's what happens. I mean, honestly, right now, that is the sort of feeling du jour.
I thought the conservative position was that, you don't get a participation trophy.
I think it's a generation thing.
Winners and losers.
I think it's generation.
It's generational.
I think so.
Now everyone's on board with this.
Yeah.
That's what's happening in the schoolyard. Everyone gets a medal and a certificate.
No, that was like 10 years ago.
Oprah Winfrey.
Shifted back.
Yeah,
now I'm confused.
It's Oprah Winfrey schooling. You get a prize, you get a prize, you get a prize.
Decade old.
Up next on the programme, a cloudy forecast for US growth.
We don't really know where the economy is going to go. I was at 2, I moved to 1. Historically, when tariffs have played out, there's been a one-time jump in prices. For me, I think there is a question about whether that's going to happen this time.
That conversation up next with Claudio Irigoyen of Bank of America, live from New York City. You're watching Bloomberg TV. Equity futures on the S&P 500 just about unchanged this morning. A revision coming in from HSBC and Max Kettner. Now underweight the United States across the board. That applies to investment-grade credit, junk credit and equities too. It's no longer about Goldilocks, Max says, but whether the sentiment shock will spill over into more US hard data weakness. Refers to the uncertainty, says it's high, we all know that, but tariff noise is likely to extend beyond April 2nd, and that's the risk for this market. The next week is not the clearing event people want to see.
And how do you price something that could change from day to day and right now is having an effect on the soft data and may or may not have an effect on the hard data? That is going to be the ultimate debate over the next few weeks.
Under surveillance this morning, a cloudy forecast for US growth.
We don't really know where the economy is going to go. Business leaders don't know, families don't know, and local policymakers don't know either. I was at 2, I moved to 1. Historically, when tariffs have played out, there's been a one-time jump in prices. For me, I think there is a question about whether that's going to happen this time. We've just gone through a period of elevated inflation, so it is very much on the consumer's mind.
So here's the latest this morning. Federal Reserve Bank of Atlanta President Raphael Bostic tempering expectations as tariff hikes impede progress on disinflation. Bank of America cutting their growth outlook for the United States and the world, writing the growth revisions seek to capture the impact of the policy uncertainty shock on spending and capex in the coming months, as well as a more hawkish tariff stance. Claudio Irigoyen of Bank of America joins us now for more. Claudio, good to see you, sir.
Thank you.
First question, hardest question. How on earth do you put out a forecast in this environment? How difficult is that?
It's extremely difficult. But to be honest, sometimes uncertainty is worse than bad news. Because that impacts the decision of companies, irreversible decisions to invest or not. So the option value of waiting is higher when you don't know what's going to happen. And you can see the Fed. The Fed is exactly in the same position. They cannot move the needle until they figure out what's going to happen.
So with that in mind, how bad's Q1 going to be?
Actually, it's not going to be that bad. January data was bad. February data was much better. So probably January was a one-off. We marked to market the first quarter. We expect probably something between 1.5% and 2%. So the first half is going to be around 1.5%, 1.7%. And the second half is going to be around 2%, which is trend growth. It's not that bad, really.
At the same time, I think what a lot of people are worried about is that tariffs are going to keep the inflation picture a little bit stickier than otherwise was on track for. Atlanta Fed President Raphael Bostic yesterday, speaking with our own Michael McKee, saying that he moved to one rate cut projected for this year because he thinks that the path of disinflation is going to be very bumpy and not move dramatically and in a clear way to the 2% target. Do you agree that now seems further out of reach?
Yeah, we had the view that inflation was sticky and was going to continue to remain sticky even before the tariff shock. And we expect PCE inflation around 3%, which is too high for the Fed to feel comfortable cutting rates with all that uncertainty that is basically upside risk to inflation. So we have the call that the Fed will remain on hold for the foreseeable future. And inflation will remain sticky, absolutely.
So it raises this question, when you talk about a growth slowdown, and Mohamed El-Arian was on this program and he asked this question, and I've given a lot of thought to it. Slowing to what? If it's not recession, if growth slows to a certain place, does it become really difficult for the United States to sustain the deficit that it has and continue with the growth that it has if you have inflation that is sticky? It's not stagflation, but it doesn't feel great.
It's a stagflationary flavor, let me put it that way. If you have the level of uncertainty that you have over the last 3 weeks for another 3 months, that will have a permanent effect on investment decisions and on consumption. So this administration can change the way it communicates to the market, because the market has no political color. They just price what they see. And the correction in the market is the market telling we don't like these policies or we don't understand these policies. So at least communication could be more transparent for the market to understand that if this is a short-term pain for long-term gain, usually markets rally when the net present value of a project is positive. So communication is going to be key. And I noticed in the last 3-4 days that communication is more careful, at least.
Well, Trump has talked about being flexible, at least when it comes to tariffs. When it comes to your inflation forecast, it's very hawkish. Do you view some of this tariffs driven?
For you to have a sense, if you have an increase of 1% in effective tariffs, that gives you between 7, maybe 10, no more than 10 basis points increase in PCE. So tariffs, the 20% tariffs on China, that gives you 2.5 points of increase in effective tariffs. So that gives you already 20 points or so on PCE. And then if you do reciprocity, you can have another 0.5 point in increase in effective tariffs. So you can have a sense. The things get more hairy when you say, okay, I'm going to also take into account when I do reciprocity, VAT. Then it's a completely different discussion.
And digital services tax and currency exchanges, they're looking at everything across the board. That's what the executive order called for. What I'm hearing from you is it's not so much the tariffs, it's the uncertainty. Could we have an uncertainty-driven recession?
Well, you really have to keep this uncertainty level for a while. 3 weeks is enough for showing up in the soft data, as we were discussing before. Still, consumption data remains strong. Our credit card data shows that consumption is resilient. You had massive wealth effects over the last year and a half. consumers hedge their interest rate exposure big time. When interest rate collapse, they refinance their mortgages. So the balance sheet of the private sector is fine. The balance sheet of the public sector is not fine. And that remains to be seen how it's going to be addressed.
It's interesting listening to the administration in the last 24 hours when they talk about challenges to the economy. They kind of brush to aside the tariff story. They will accept, though, that DOGE and the rebalancing of the economy away from government spending towards the private sector could be damaging. And we heard that from Stephen Mirren, the chair of the Council of Economic Advisors, just yesterday speaking to Bloomberg News. I don't think there's going to be a material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. How do you and the team think about DOGE and what it could do to your outlook?
I think it's too early to tell. There are a lot of things that the administration say we're going to do it, and it's not easy to implement. The execution risks are still high. But DOGE is another example in which uncertainty is not enough to characterize this economy. You have to add to the uncertainty confusion. So we can agree that tariffs will be 2%, 10%, 20% higher or not on April 2nd. We can agree on the probability distribution of that random event. But we can disagree, and people disagree a lot on the effect of that on the economy.
When it comes to DOGE, is your concern in the effect of the economy on the labor market and potentially the business contracts that you have the private sector doing with the U.S. government?
It's still, when you quantify it, it's still relatively minor and very concentrated on some geographical areas, the DC, etc. But it's going to impact on sentiment, right? So it creates uncertainty of where we are going. So if you have a master plan that has different pillars, energy, immigration, fiscal consolidation, tariffs, you got to put it together and explain to the market, this is what we have in mind. If you do it piecemeal, you create confusion.
Well, they have a master plan, but they're doing it piecemeal in the sense that they're addressing tariffs first. By the end of the year, they want an extension of TCJA, and they want deregulation along the way. If you take the Trump administration's economic policy together, do you think it's a fair outcome?
What we have in our forecast is an economy that eventually will continue running around potential. I think policies can have the right, the idea could be great, but implementation risks are very high. If you impose tariffs in the morning and remove it in the afternoon, even if you end up with 10%, 20% tariffs at the end, that transition doesn't help.
It's difficult to plan with that backdrop, that's for sure.
Absolutely.
Claudio, it's good to see you. It's good to catch up and get your thoughts from the team over at Bank of America. Claudio Irigoyen there. The detox this administration is talking about, what they consistently reflect on, refer to, is government spending. It's not about the tariffs. It's about moving away and weaning this economy off government spending, which has produced some tremendous results in this economy just in terms of headline growth. We've been talking about 3% GDP growth for the last 12 months or so. We've been running a deficit north of 6% with unemployment at 4%. It doesn't really make sense that we've been doing that for the extent that we have done.
And a lot of people would agree with that you need to rectify that situation at a time where what Stephen Mirren was saying was that 3/4 of the growth and the employment was somehow tied to some of this government spending. At this point, the question is the implementation risk, just as Claudio was saying, and just how strategic some of these plans actually are in achieving the ultimate goal, which is reducing that deficit.
You don't want to pay for this with a recession. Secretary Besson, I think, was pretty clear in that, in some of the conversations we've heard from him, particularly over the last week. Equities at the moment on the S&P 500, just about positive. Coming up next on the programme, we'll be catching up with Cameron Dawson of NewEdge Wealth, Libby Cantrill of Pimco, Tom Narayan of RBC, Sonal Desai of Franklin Templeton. From New York City, this is Bloomberg.
Humility is clearly a term that should be utilized now.
None of us actually know exactly what's going to happen.
We are at an unprecedented level of uncertainty.
The commentary on the outlook is as wide as I've never seen it.
I would put a much higher probability that we don't have clarity after April 2nd.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now on a two-day winning streak on the S&P 500 and looking to add just a little bit of weight to that rally. Equities up on the S&P marginally by not even 0.1%. On the Nasdaq 100 this morning, just about unchanged. The next stop for this market, plenty of data through the week, but look out for this one in 3 hours' time at 10 a.m. Eastern Time. U.S. consumer confidence data. Another read on how the consumer feels about the tariff volatility.
The soft data taking an increasing amount of importance. It is the fastest moving data point that people are clinging to understand what the uncertainty that we talk about every single day ad nauseum is really doing to consumer confidence. I do wonder how much people trade on this, because we have seen time and time again that it hasn't filtered into hard data. We were just speaking with Claudio of Bank of America, who said it usually takes 3 months before it really starts trickling into that hard data.
And the tariff proposals seem to change from day to day, hour to hour. The President of the United States yesterday teasing a lighter touch on tariffs and setting up some negotiations down in Washington, D.C. Later on today, a meeting between the top trade chief out of Europe alongside the Commerce Secretary, Howard Lutnick.
There's a rush from all these trading partners to want to get a deal before April 2nd. But I think what you see from President Trump in his latest comments and the rhetoric is that he's willing to be flexible. This quote: "They've charged us so much that I'm embarrassed to charge them what they've charged us." It'll be substantial, and you'll hear about it on April 2nd. But you see there is movement potentially for this negotiations to take place, and he seems to be in deal-making mode.
So what are businesses doing? They're waiting. The Federal Reserve is as well. I would look out for those comments coming from the New York Fed President John Williams just a little bit later on today, as they have to confront real risk. Apollo's Torsten Slog this morning calling those risks stagflation risks, and those risks are rising.
Yeah, and that seems to be what was reflected in the statement of economic projections, which we saw, and frankly, what was reflected by Atlanta Fed Chair Raphael Bostic speaking to our own Mike McKee, saying that essentially inflation is going to have a harder path down to 2% than it otherwise would have, even though growth is decelerating. Again, are they hawkish? Are they dovish? You can keep debating that because it's not going to be resolved.
We found out where his dot was, though.
Yeah, what?
He's come down from 2 cuts for 2025 to 1, and he's not alone.
There are 8 other people who have done the same thing, which is a reason why there was a sense that maybe this is hawkish. At the same time, how high is that barrier to understand slower growth? And what are they looking at? It puts the emphasis on core PCE, which we're going to be getting on Friday.
Lots of data through the week, including consumer confidence later on this morning at 10 a.m. Eastern Time. Equity futures going into that just about positive by 0.1%. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth as investors exhale. Libby Cantrill of Pimco as global trade partners race to make deals in Washington. And Tom Narayan of RBC as Tesla sees continued weakness out of Europe. We begin this hour with stocks steady after notching one of the best days of the year so far. Cameron Dawson of NewEdge Wealth writing, "Our key message to clients is get comfortable being uncomfortable. We see volatility continuing even as we bounce off of oversold, low sentiment levels." Cameron joins us now for more. Cam, it's good to see you.
Good to see you.
Let's talk about your conversations with those clients.
Yeah.
What are they telling you? Are they freaking out? Are they bearish? What's the response?
Clients are still very calm, and we think it's because if you look at a 70-30 portfolio of ACWI versus the ag, you're still up about 1% for the year. So yes, we have seen this weakness within U.S. equities, but if you are a diversified investor for the first time in a while, you actually feel good about having non-U.S. exposure, which has helped to dull some of the pain that you have seen within the concentrated U.S. markets.
How far out are they willing to extrapolate that recent underperformance, US versus Europe? Are they starting to wonder whether this could be a multi-year game or is it a short-term game?
We're certainly asking that question, meaning are we going to see a repeat of the 2000 to 2007 period where it truly was a multi-year period of non-U.S. underperformance versus the rest of the world? We think it really depends on 2 key factors. You have to see continued dollar weakness. You have to see much further downside in the dollar to suggest that capital will leave the U.S. and go to the rest of the world. And you have to see it backed up by earnings. So if you look year to date, all of the outperformance of Europe has been driven by valuation expansion. It's gone from 13.5 times to 15 times. Earnings estimates have actually gotten cut. So if you think that this is going to last more than just a couple of months or a couple of quarters, you have to believe in the earnings story.
So how do you understand that multiple shift? How do you understand the idea that we've seen a weakening in the dollar and a sell-off in the S&P 500 for one of the longest periods that we have in the past few decades? If it isn't necessarily some fundamental shift, what is it?
We have to appreciate that we went into this year with a massive record dollar long position. If you looked at futures trading, you had a huge position where everybody was long to their eyeballs the dollar. That has now reversed, and you actually see traders being slightly short the dollar. So we think that the dollar could actually find some stability here. Maybe in the short term, you see some mean reversion in some of those trades. The last 2 days, Europe has been underperforming the U.S. So it's very alluring to try to ascribe a narrative to price action, to say end of U.S. exceptionalism, the U.S. exceptionalism story is over. We think it's actually a lot more about dollar positioning, at least in the short term.
Yeah, you said this question in your notes, which I thought was great. Is it the end of U.S. exceptionalism or just a positioning unwind? Seems like maybe it's a little bit of the latter. I am curious what this means going forward then. If this gives the sense that not only will there be stability to the dollar, but also, say, to the Magnificent Seven, which have unwound at a disproportional pace.
Well, and we do think the weakness of the Mag 7 was a function of its strength at the end of the year. Mag 7 outperformed so much in December that was not justified by the fundamentals. Earnings estimates were getting cut. It was all valuations. So this is all just these positioning shifts moving around. We've now gotten to the point where positioning is a bit more balanced. You've gone from the 98th percentile in U.S. positioning to the 26th percentile. That does set you up for a little bit of a relief rally. The question is, Europe is still trading at 15 times versus the U.S. at 20 times. What's the driver to potentially see those multiples converge further?
You know, you said get used to being uncomfortable. There are a lot of people who say, I don't want to be uncomfortable. I want to have some sort of forward indicator to get an edge at a time where it seems like there's a lot of noise and nothing else. What are you looking for to change materially to get some conviction one way or another?
We have to start from the basis that indicator economics and what used to work in prior cycles does not work in the post-COVID world, which means that we can't look to things like the 10-2 curve of telling us if we're having a recession. We can't look at those sentiment indicators because they've been so misleading. One of the things over the last 2 years that we've been saying is that watch what they do, not what they say, meaning that you cannot look at sentiment and soft data and extrapolate it into hard data. We think it's actually more important to look at what the equity market is saying about the consumer, for example. So look at equal weight discretionary versus staples. If discretionary is underperforming staples, the equity market is sniffing out that there's trouble in River City with the consumer. If it continues to be in an uptrend, then the equity market is telling you a message of it's okay.
Watch what they do, not what they say. Are you also using that same logic when it comes to policymakers in Washington?
Not necessarily. There has been follow through in what they've been saying. And I think that that was one of the follies going into this year, thinking that it was all just rhetoric coming out of D.C. and that we wouldn't see policy follow through. But we certainly are seeing it, at least to an extent. Yes, we have the flip flop and the ping pong about how much we're actually going to see tariffs enacted. But there are real policies being enacted, which is weighing on activity that we see today.
April 2nd is increasingly difficult to understand. The Financial Times just put out this report that the president is considering a two-step tariff regime on April 2nd, according to people familiar with the matter. Among proposals, and I'm citing this story directly now, his team has been discussing is a plan to launch so-called Section 301 investigations into trading partners, so that's unfair trading practices, while simultaneously using rarely invoked emergency powers to apply immediate tariffs in the interim. So you could see a couple of phases of this, which is a reason why the people like Max Kettner of HSBC are worried that this uncertainty will linger beyond April 2nd. And Annmarie, this is something you've talked about repeatedly. There are things you can do on day one, on April 2nd. There are other things you'll have to wait to execute on.
Right. If you want to use Section 338 or IEEPA, you can maybe use national security lever, and you can have a tariff that day in an executive order. If you want to look at something that is more long-term, if you need public feedback, then you would take weeks or months. But what the Financial Times is saying, and it's something I think makes sense for how Trump likes to enact policy, you might see both on that day. Come out with something really sharp because he wants to deliver, but then at the same time, it's a little bit more nuanced when it comes to maybe specific countries or sectors.
Cameron, this makes April 2nd really tough because is it going to be a clearing event? Maximum uncertainty, move beyond it, move on by stocks, or will it just get more confusing?
I think that Peter Cheer earlier this week was really wise in saying that if we get clarity, is that actually a bad thing, in the sense that the current EPS estimates do not contemplate the kind of tariff regime that's even the tariff light that is being presented, which means that we do think that there is downside to earnings estimates if we get the clarity that people can actually start putting it into numbers. We see this arrested development in decision making. It's if you choose not to decide, you are still making a choice. Businesses are sitting on their hands and not making decisions, and that could result, we think, in lower earnings estimates, which we think challenges the valuations of equities even further.
Bad thing for who? And bad for which equities? The United States or the outperformance we've seen in Europe and elsewhere in China?
I don't think that the European rally has been pricing in the risk of tariffs being escalated, which just means that you're seeing all of this strength in re-rating, which is more of a positioning flip than necessarily thinking that Europe is going to do better because of the tariffs. So if we actually see them enacted, we think it's more of money leaving global equities versus shifting from one place to another.
I'm with you. I love the piece from Pete over the weekend. Careful what you wish for. If you get the clarity, you get the certainty, is that when we start to fully appreciate the kind of damage it could do to the economy? And I'm not talking about the United States. I'm talking about the rest of the world.
Which is something that people were pricing in at the end of last year and everybody seemed to ignore because they were all benumbed by the idea of Germans spending money. And that seemed to take everyone's idea of what tariffs would do to the rest of the world out of the minds.
Cameron, good to see you, as always. Great to catch up. Cameron Dawson there of NewEdge Wealth. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. U.S. and Russian officials met in Saudi Arabia a day after American and Ukrainian teams held talks. The discussions focused on the safety of navigation in the Black Sea and a potential maritime ceasefire. The ultimate goal, though, achieve a broader and permanent peace. Ukraine's ambassador said that they support the U.S. push for a full 30-day ceasefire. Boeing reportedly wants to withdraw from a plea deal with U.S. prosecutors. It previously agreed to plead guilty to misleading regulators before 2 deadly 737 MAX crashes. The Wall Street Journal now reporting that Boeing is seeking leniency from the Trump administration, which is reviewing pending white-collar criminal cases. Elsewhere, Google's Waymo plans to expand robo-taxi services to Washington, D.C. next year. The move would give U.S. lawmakers and officials more exposure to self-driving cars as they develop federal testing standards. Waymo said that it still needs to work with the D.C. government for permission to operate without a human driver. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, counting down to Liberation Day.
They've charged us so much that I'm embarrassed to charge them what they've charged us, but it'll be substantial. And you'll be hearing about that on April 2nd. And it will be Liberation Day.
Up next on the program, Libby Cantrill of Pimco, live from New York City this morning. Good morning. Equities on the S&P 500 just about positive by not even 0.1%. Just two things to look for throughout the day, two of many, but these are the ones that I would focus on. Consumer confidence coming later this morning at 10 a.m. Eastern time, and then you will get some Fed speak. Look out for the New York Fed President, John Williams, speaking later on this morning. Under surveillance this morning, we're counting down to Liberation Day.
We may take less than what they're charging because they've charged us so much. I don't think they could take it. In other words, they've charged us so much that I'm embarrassed to charge them what they've charged us, but it'll be substantial. And you'll be hearing about that on April 2nd. And it will be Liberation Day because we'll be taking in large amounts of money for our country.
So here's the latest this morning. Officials from the European Union and India rushing to offer concessions to the United States ahead of the April 2nd reciprocal tariff deadline, as President Trump signals some countries will get breaks. Joining us now is Bloomberg's Tyler Kendall. Tyler, which countries will get breaks? I think that's the most important question going into next week.
Yeah, well, John, that remains to be seen. Our Bloomberg News reporting indicating that President Trump is taking into account whether or not countries have been cooperative or combative when it comes to these talks. Of course, some prime candidates, of course, would be those countries that have no tariff barriers, low tariff barriers, or run a trade surplus with the U.S. Now, you mentioned there those high-stake talks with the EU's trade chief today here in Washington, and we have to keep in mind that when it comes to the EU in particular, they have faced some pretty tough rhetoric from President Trump. We're talking a lot about concessions. For example, we know that this White House would like to see the European Union drop its tariffs when it comes to American auto imports into the EU. But we also have to keep in mind that these discussions are revolving around those non-tariff barriers too, including value-added taxes and digital service taxes, which would be considered a pretty lofty goal for this administration. I was there last week when NEC Director Kevin Hassett was asked if this White House is really looking for European countries to dismantle their entire tax systems, and his response was that this White House would be, quote, sensible in regards to that. Another ongoing negotiation we know about today, an American delegation touching down in India. I will say that President Trump has often labeled India a, quote, tariff king. It does appear that they are starting to peel back some of their tariffs, but that President Trump doesn't seem rather optimistic that they are going to be lowered when it comes to India. However, John, it is prompting some economists to be potentially optimistic that the country could be reversing some of its long-held protectionist policies.
So meetings with the Europeans, meetings with India, as well as a call with the Chinese. Tyler, are we going to have any certainty on April 2nd, though?
That is one of the biggest questions that remains to be seen. At this point, there are a lot of different things up in the air. Potentially, we could hear some of these countries coming forward with those tangible concessions that this administration is looking for. Particularly, we know that there's being progress made, even if it's slowly, when it comes to China. We had Senator Steve Daines, a Republican from Montana, coming back from over the weekend from Beijing. Now we have this next step when it comes to the USTR's call. But it really does remain to be seen, particularly as we look ahead, that April 2nd, as of now, will not be paired with those sector-specific tariffs, but that those also could be coming. President Trump previewing auto tariffs could be here any day now.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. To extend the conversation, joining us around the table here in New York, Libby Cantrill of Pimco. Libby, good to see you.
Good to see you.
Attempting to read the tea leaves in Washington is a dangerous game, but we're going to play it just quickly. Do you think maybe based on the comments of the last 24 hours, the President and this White House are realising some of the legal constraints around what they can and can't do on April 2nd?
Yeah, and what we know about his trade advisors, Jameson Greer in particular, who's his U.S. trade representative, he is particularly focused on the legality and the durability of these tariff actions. I mean, remember that April 2nd was sort of the date that was set out in the executive order in the first week of the administration that really was supposed to clarify kind of the trade agenda. It was before the Canada and Mexico tariffs, before the Colombia threats, before the aluminum and steel tariffs. So I think in some ways this should, provide some coherence in terms of the trade agenda. But again, the legality, I think, is very crucial here. One thing that we've been talking to clients about is this just an announcement of future tariffs? Is this sort of forward guidance, if you will, for tariffs? Or is this actually an announcement that tariffs are rolling on April 2nd? And I think that actually has to interplay with the legality. If this is being used under IEEPA, then he can do this day one. If this is more of a broader investigation, then that will take several months.
Well, the FT is saying it's both. There's going to be two tiers. Potentially we get some tariffs day one, and then longer term they're going to look into some trade imbalances. I love that you talk about mind-numbing process, because I actually think it's important whether or not they use IEEPA, whether or not they use 338. Can you walk us through what they potentially have a menu of to enact on April 2nd?
Yeah, I mean, as we've discussed before, the executive branch just has wide discretion in terms of what they can do on tariffs unilaterally. So, of course, they don't need to go through Congress for any of these things. These are authorities that they already have. But they do depend in terms of timing. So Section 301, for instance, that's an investigation that usually looks into a specific country's practices. That investigation can take months. This is the authority that the Trump 1.0 put tariffs on China. So if it's an announcement of a 301 investigation, then again, you're kind of giving the market some forward guidance about what to expect. If they use IEEPA, if they use Section 338 of the Tariff Act from 1930, then
it's huge. It's up to 50%.
Then those can go on day one. So I think this is where Jameson Greer, though, who is a trade attorney by background, again, U.S. trade representative, I think is going to be very focused on the legality of all of this, the durability, and the fact that he doesn't want to be fighting this in courts, right? He wants this to stay. This is supposed to be a part of a broader kind of either national security and economic agenda. And again, he's going to be focused on.
So you're outlining how they may be able to get there legally. What countries do you think they're going to go after?
Yeah, I mean, if you just look at the trade deficit and this president, people may agree with him or may disagree with him, but he's been incredibly consistent about his focus on the goods trade deficit in particular. And if you look at those countries with the biggest goods trade deficit, it's China, It's the European Union, it's Mexico, and it is Canada. And then he's also going to be looking at the tariff rates. And this is where I think it does get a little bit complicated. I think that reciprocity broadly in terms of the administration, they agree on this idea of reciprocal tariffs. But how do you calculate that tariff? Does that include things like the value-added tax in Europe? In which case, that reciprocal tariff that we would impose on Europe would be much higher than what the stated tariff level is. So I think there are obviously a lot of open questions about what this actually means. But I do think we will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
Well, the market seems to like the lack of clarity or just tea leaves that they've been getting over the past couple of days. Have we gotten any further clarity or any more of a sense of what the framework looks like over the different speeches that we've heard over the past few days, kind of in tandem with what the market's sniffing out?
Yeah, and again, is this intentional, kind of a softening, a walking away from some maybe the more draconian measures, or is this maybe just a byproduct of the fact that this was supposed to be really the big reveal, if you will, of the sort of the administration's trade policy, and it wasn't supposed to be necessarily sort of so draconian, I don't think. I think it was supposed to be part of a broader economic strategy. And so I think some of that is we're just sort of seeing that kind of fleshed out.
How much do you think the sequencing of this matters, where they want to get this out of the way and then pencil in certain revenues from these tariff plans to then bring to the tax discussion that is very much going to come to the fore in the remaining months of the year?
I mean, we've been using this framework with our clients, the vegetables and the dessert. And we knew that the Trump...
I take issue with that. Vegetables are good, but Trump
wait, it sort of depends on what you're steamed vegetables and dessert and ice cream sundaes. How about that?
Thank you. That's perfect.
But we've had a lot of steamed vegetables, right, without salt. And we have not had a lot of the ice cream sundaes. And so I do think this was sort of what we expected, that there was going to be this kind of push and pull in terms of economic policy. But in terms of the market, they've had to stomach much more vegetables than dessert, to belabor the metaphor. So I do think there's going to be a quick pivot to what are the things that they can do from a growth agenda perspective. And then I think the big question, I think for the markets and for bondholders, is what is the deficit impact? Because I'm skeptical that a lot of these sort of spending cuts that have been penciled into the kind of framework that is being proposed in the House in particular will actually be enacted into law. I think those things are very difficult, easier said to do than actually to do.
You've got Doge doubts. What happens with Doge?
I do have Doge doubts. Now, this is an active discussion within the walls of Pimco, so this is my personal view. Sure. But if you actually look at, and this is, again, mind-numbing process, but actually quite important, anything that is that Congress has already appropriated, spending that they've already appropriated, that gets then kind of cut or pared back by Doge, that does not go to the Treasury General account. That does not go to pay off the deficit. That by law goes with basically a checking account within that agency and has to sit there for 5 years. This, I don't think necessarily the market understands. That means that, again, these make good sort of sexy headlines, if you will. But in terms of actual deficit reduction, we definitely haven't seen that yet, and you have to get that enacted by Congress and codified into law.
Libby, it's good to see you. As always, great to catch up. Libby Cantrill there of Pimco, breaking things down on both the trade front and the tax front. The tax story is going to be tough. It's going to be really, really tough, because just extending tax cuts, just from a political perspective, going to the midterms next year and campaign on the counterfactual, well, we got this done and it could have been so much worse if we didn't. That doesn't work. What are the additional tax cuts you're going to offer people? What's that going to look like in 12 months' time?
You got to have a sprinkle on that Sunday in order for this to really nail a punch when it comes to the midterms, and also Trump basically pledging on the campaign trail that he would deliver more, whether or not it's no tax on Social Security, no tax on tips. Getting that through Congress, incredibly challenging because of how slim the majority is in the House.
To take it a step further, it's not just that you can't show people that much of a difference. It's that in order to pay for the extension of those cuts, you're going to need to really consider cutting Social Security and Medicaid.
It's a lot going on, but it's a little bit snoozy out there this morning. That's a good thing. Equity's just about unchanged on the S&P 500. Lots going on for Tesla as well. Tons of drama in the last month or so. Tom Narayan of RBC joined us next as Tesla sees continued weakness out of Europe. Equities just a touch firmer on the S&P 500, higher by close to 0.1%. Just a programming note, Max Kettner, HSBC, underweight the US across the board now. IG credit, high yield credit, equities too. Max joins us tomorrow, 6:30 Eastern Time on Bloomberg TV, right here on Bloomberg Surveillance. Do not miss that tomorrow morning. With 2 hours until the cash open here stateside, let's get you your morning calls with Danny Berger. Hey, Danny.
Hey, John, maybe another reason to be bearish. KB Homes out warning of pain with the consumer. They had earnings. If this share fall sticks into the open, it would be their worst day since 2020, a decline of more than 8.5%. They cut their view for the full year, saying that the consumer has an affordability issue, and that uncertainty, that's the word they used, over both macro and geopolitics means that they are delaying big home purchases. Now, to the upside this morning in the pre-market, we have Trump Media, DJT, that's up 8%. They've signed a deal with Crypto.com. Crypto.com will now sell them ETFs, which they say are tied to digital assets and U.S.-focused investments, calling it an America First type ETF. Those will be on sale this year, pending regulatory approval. Rounding things out with BABA. Look, Chinese tech stocks had a really difficult run today. They are nearing a correction after their spectacular rise. Alibaba, though, particularly in interest, down nearly 2%, with the chairman warning that there might be a bubble forming in data centers, that there is more being built than there is demand for. John, it is serious consequences for the hyperscalers and the investment infrastructure funds that have been plowing money into data centers.
A bubble warning from Baba. It's quite a story. Danny, appreciate the update. Thank you. And I'm pleased you went to KB Homes as well. It's not just the survey data. You're seeing it from the earnings. You're seeing it from the companies. It started with Delta Airlines. You said in the middle of February, things started to stall out. KB Homes, a miss on the top and bottom line for the first quarter, and Lisa, a cut to the outlook.
This has been one of Neil Dutta's points, that if you take a look at the home builders, they usually lead on the way up and they usually lead on the way down, and they've been performing really badly. They're getting hit on a whole host of different levels: affordability, costs of labor, and also this uncertainty of the interest rate outlook.
So what does it mean for the Federal Reserve and interest rates? On our radar this morning, Atlanta Fed President Raphael Bostic seeing just one rate cut on the table this year as a result of tariffs. We get more Fed speak through the week. You'll hear from Kugler and Williams today, followed by Kashkari and Muslim tomorrow.
Michael McKee asked Raphael Bostic about the word transitory and whether he would agree with Jerome Powell. He said, "I am not going to say that word, nope." And this to me was really interesting. Does Jay Powell represent the mainstream of the Federal Reserve when talking about the likelihood that the tariff effects would be transitory and that some of the increase in inflation that they could see later this year truly is something that they could look through and focus instead on the weakness? That was not the view of Raphael Bostic.
Depends who you define as the mainstream of the Federal Reserve. Do I think there's some daylight between him and a lot of officials? Absolutely. And you saw it in the forecast, which was what was kind of odd about that meeting last week. If you looked at the dot plot, the distribution of the dots for interest rates this year, that skewed really hawkishly. There were some committee members that said, you know what, I thought 2, now I'm thinking 1. And it wasn't just Raphael Bostic, it was others too, as they were looking out 12 months or so. Are we thinking of Governor Waller? Is he on board with Chairman Powell? Probably, based on what he said on tariffs in the last few months. Are we thinking of New York Fed President John Williams? Most likely. He's going to speak later. I imagine he will echo the sentiment that came from the chairman. But I'm with you. There are other people on the committee where there's some real daylight between that performance in the news conference with him and what they're seeing elsewhere.
And the reason why that's important is because to understand the reaction function of the Federal Reserve, it is important to understand where the gravitational force is. It has been with Fed Chair Jay Powell. At this point, it's going to be really important to listen to all the different Fed officials to understand whether there is enough of a mainstream on the other side to push back against that kind of view.
Understanding tariffs and what it means for this economy is going to get harder potentially. Take a listen to this. President Donald Trump threatening so-called secondary tariffs of 25% on countries that buy oil from Venezuela, saying in a Truth Social post and an executive order that Venezuela has been hostile towards the United States.
What I find interesting about this is it's been written in a way that gives the State Department flexibility in determining who is going to get hit with that extra 25%. Basically, China will be the one, but maybe not other countries that might have to buy some Venezuela crude. The bigger issue, though, is how do you actually track this? Say you're a vessel that is carrying Venezuelan crude. Can't you just maybe sell it to a Russian vessel in the middle of the sea and then Russia can sell it to China? The problem is, how do you enforce this? It's been a huge problem when it comes to Iranian oil, which is why Iran has been able to sell 1.5 million barrels a day to China. The tariff could be there, like the sanction could be there, but you have to enforce it.
With great difficulty is the answer. I had a message from a Bloomberg subscriber just moments ago on this topic. Said this: someone should ask why the United States consumer has to pay a higher consumption tax because China is importing oil from Venezuela.
Okay, I'd like to hear the answer to that. It seems like sanctioned is a dirty word and tariff is a beautiful word that is going to be deployed in all sorts of different ways. Whether it's used to the same end and whether it can be used to the same end remains to be seen.
Need to talk about the autos too. Tesla's European sales falling in 10 of the last 12 months. The EV maker seeing a 43% decline in the first 2 months of the year, deviating from the 31% rise in industry-wide EV registrations. To discuss, Tom Narayan of RBC joins us now for more. Tom, we've talked about this with you before. Does this data point matter or not? Does it matter to you?
Yeah, I mean, any data point matters. I love data. I'm an analyst. But what I would say is what I've said before, right? We have to put everything in context. There are an affordable car that's coming. There is the Model Y refresh. There's definitely potential that this Osborne effect is taking place. Consumers waiting for these new vehicles to come. Also, January and February aren't exactly the most, thrilling months to extrapolate data from. And they had the intentional shutdowns, right? And look, we're talking about a few thousands of cars. We focus too much on the growth rate, as we've talked about before, in the context of 1.7 million cars sold last year, being down by a few thousand. I understand the market was up, but I do think we need to take everything, look at the big picture here. Let's see what March does. Let's see what April does, what these new vehicles do before we start getting, overly excited about this data.
Tom, you know the story. It's reinforcing pre-existing concerns before we even got this data. Concerns about a potential for a consumer boycott. This is where that particular subject gets a little bit more complicated. If you look at how Doge polls in the United States, Doge polls really quite well based on some of the reviews and surveys that I've seen in the United States. Where do you think this is breaking down? Is there a real potential for people to turn around and say, I don't like the work Elon Musk is doing in the government, I'm not going to buy a Tesla? Is that actually what's happening?
Well, I mean, again, I'm an autos analyst. I can only tell you what I'm hearing from investors on the subject. And what I've been hearing is, a car purchase is very different than, let's say, boycotting a can of soda was the example I was given. People are going to buy what's best for their families. In the U.S., Tesla is half of the entire EV market. If you're taking the plunge and buying an EV, will you buy this product, which for all intents and purposes is a good product, or will you buy a product from a different brand? The switching costs are very difficult there. But again, I'm just an autos analyst, not a political scientist. I'm just looking at the data right now, and at this point, we need to see how these new vehicles fare in terms of demand.
Tom, moving away from the political sphere, there's a question about how much some of the question marks around Elon Musk have really encouraged competition to ramp up, particularly overseas, and maybe have more inroads, at least with consumers in the short term. And I'm wondering not just about BYD, but I'm also wondering about European models like Citroën or Stellantis or Renault that come out with these cheaper models to try to compete with their Chinese brethren that are coming with autos to sell in the European Union. Does that pose a threat to Tesla longer term, that there is this kickstarting in the competitive angle?
Yeah, but I'm not sure anything has really changed. I mean, Europe is definitely the kind of third engine, right, for Tesla, right? The focus is really China and the U.S. I'm actually really more worried about what's happening in China with competition there. Sure, Europe is very competitive, but remember, Europe is like 2x the EV penetration as the U.S. So it's a great market for Tesla to penetrate, and they have very low penetration right now. They have the plant in Berlin, which is ramping up production and producing there. Certainly, it's a very competitive market with Chinese coming in, etc. But yeah, it is important, but it is the third engine there for Tesla. I'm more focused. My concern is more on the domestic Chinese market for Tesla. But again, we need to see how these new models fare, the new Model Y refresh, and of course this affordable car, which with the IRA credit in the U.S., remember that's still their most important market. You can get it for $30,000. We have to see how consumers react to these.
How much have investors been pushing back against your buy thesis on Tesla at a time where there has been so much discussion about this name? And I'm talking about the past few weeks.
Yeah, I've done a ton of discussions with investors. I'll be honest with you, the big topic is really tariffs. But yeah, I mean, Tesla definitely comes up. I think a lot of folks are looking at the stock tactically. Typically, they're looking at how far the stock has had pulled back, and they're trying to understand if now is a good entry point. Some people are doing real fundamental work on the name, and I'm happy to provide my robotaxi analysis, which I've spent a lot of time and work on, and pleasantly surprised that people are doing their homework. I think that part of that is because the stock's pulled back, and they realize, look, car sales definitely catches a lot of headlines, but at the end of the day, we think this is an autonomy company. So we love the fact that they're doing their work on what's happening not in 1Q24, but in the year 2035, the year 2040, and we're really happy that some investors are looking at it that perspective as well.
But Tom, in the short term, there was a recent poll the last few days out of Germany. 94% of respondents of 100,000 Germans said they will no longer buy a Tesla. And obviously, Germany is where we see this rejection, really, when it comes to some of the sales of these cars. I know you're thinking long term, but how concerned are you that this brand reaction to Musk could be pervasive?
Yeah, and I mean, I didn't conduct that poll. I did see some pushback on that poll in the press in terms of who the respondents were, but again, I'm not part of that poll. But again, I think at the end of the day, we need to see how these new vehicles fare. Europe is very underpenetrated for Tesla. They're still growing there. It needs to electrify because of CO2 compliance in Europe. Tesla provides a compelling product. So do other European OEMs. So we just have to see. I think obviously there's a lot of stuff in the press, but at the end of the day, people are going to buy the best product for their families when it comes to a big ticket item like a car.
Let's get to tariffs, because you say that's what everyone in the industry is talking about. And that's what we're talking about as well. Besides April 2nd, Trump laid out somewhat of a timeline for sectoral tariffs, and he characterized auto tariffs as coming, quote, in the next few days. Tom, what do you make of all of this?
Yeah, I mean, I think we saw a similar playbook back in the first Trump administration, right? Because, I mean, if you think about it, if there is a decision on April 2 and it is severe, it will have a dramatic impact, right, on this industry. And so, what happened before was you did have some information, some decisions actually even happened before the tariff war is supposed to take place. So it does make sense that we could have some clarity before that happens. I will say that from these investor meetings, we've had quite a few in the past couple of weeks, there is a consensus, and we heard obviously from what was reported over the weekend, that perhaps Canada and Mexico tariffs could be averted thanks to USMCA and how the U.S. auto industry is largely compliant there. And there is a consensus brewing about reciprocal tariffs that they perhaps could be implemented, although some pushback from some folks saying it's unclear how they would necessarily help the U.S. auto industry. And as we saw from the first Trump administration, neither actually were ever implemented.
Stock is up this morning by 1.4%. I think we're up about 25% since Governor Walz downgraded the stock. Tom, it's good to see you. Tom Narayan there of RBC. Did you watch that rally? Governor Walz, Minnesota?
No, I did not.
Had his phone up, looked at the stock, and OK, move on. All right, let's give an update on stories elsewhere this morning. Someone got that joke. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The FT reporting that President Trump is considering a two-step approach to his new tariff regime on April 2nd. The report cited people familiar with the discussion, saying Trump's team is weighing proposals that would give a legal framework to reciprocal tariffs. It would also act as a tool to apply up to 50% tariffs on trading partners. Private text between Vice President J.D. Vance and Defense Secretary Pete Hegseth said European allies are freeloading off of U.S. efforts in Yemen. That back and forth was revealed after the Atlantic's top editor was accidentally added to the group chat. The messages also suggested that the cost of the Houthi strikes be levied on the Europeans. Millions of Americans who sent their saliva to 23andMe may now see their genetic information sold to the highest bidder as part of its bankruptcy filing. The company proposed an auction for the sale of its assets in May, sparking privacy concerns. 23andMe said that customers can delete their genetic information off of their accounts. And that's your brief, John.
Some scary stuff right there, Danny. Thank you very much. More from Danny later on in the next hour. Up next on the programme, Trump calls for a rate cut.
I'd like to see the Fed lower interest rates. That's just my opinion, because things are coming down. We have inflation under control. Tremendous amounts of money will be soon coming in from tariffs.
Up next on the programme, Sonal, Desai, Franklin Templeton, live from New York City. This is Bloomberg. Stocks about in here on the S&P 500 up by 0.2%, looking to build on 2 days of gains on the S&P 500. Mentioned Max Kentner of HSBC a few times already this morning, downgrading US equities. There is a constructive view out there, though. Evercore's Julian Emmanuel saying the bull still lives as the tariff liberation day approaches. JPMorgan's Dubravko Lakos-Buja saying the risk of another violent unwind should be low in the short term. We add to some of the recent relief. The Nasdaq is higher by 0.1%. Out of surveillance this morning, Trump calls for a rate cut.
I'd like to see the Fed lower interest rates. That's just my opinion, because things are coming down. We have inflation under control. Tremendous amounts of money will be soon coming in from tariffs, which is about time that we were able to partake. We've been ripped off by every country on that basis.
So here's the latest this morning. President Trump reiterating his call for the Federal Reserve to cut interest rates. Sonal, Desai, Franklin Templeton sticking with her call for at most one rate cut this year, writing while tariffs and immigration have come up front, concrete action on deregulation and tax policy is expected to follow. And these are the two elements that should help tilt growth and contain inflation. Sonal joins us now for more. Sonal, good to see you. That's a more constructive view on US growth. A lift to growth at the end of the year, potentially.
Well, I don't know whether we wait until the end of the year, but a slightly more constructive view than perhaps some in the market have taken. At the end of the day, we've had a couple of months of definitely freezing up as everyone, looks at the sequencing being exactly the opposite of what they would have liked to have seen, which was the nice stuff first, and we didn't get it. And we all expected it, and instead we got the complications, the uncertainty, the changes by the Fridays to the Mondays on what policy would be, which gives very little visibility, and markets don't like that.
And yet, even with that, bond yields are north of 4% across the curve.
Yes.
So where will they be as we work our way through the rest of 2025?
So I'm not actually changing my call for fair value on the 10-year to be between 4.75 and 5 here. And that is because I would anticipate that we aren't actually at the point of an actual recession. We're seeing a freezing up of growth, and then there's likely to be a catch-up if we actually see the tax cuts and deregulations which were promised to us, because those are growth positive. Now, we can discuss the long-term impact on debt sustainability, et cetera, of expanding tax cuts, but from the market's perspective, and this year and next year, it's positive if we get that.
What you're saying right now explains to me why yesterday, on a day of maybe relief that there wasn't necessarily another tariff announced or potential softening in some of the terms, we saw the biggest one-day rally in high-yield bonds going back to August of last year. It speaks to exactly what you're talking about, that people are betting that we are not going to get a recession and that riskier credit will do better.
I think essentially that is correct, because every time I see the headlines on imminent recession, I look at those fixed income risk assets and as far as I'm concerned, there's cognitive dissonance. Nobody's throwing out their risk assets on the back of a recession, which if it were coming, you would not see high yield spreads where they are. You just couldn't. And the fact is that the market participants are betting on someone coming in and easing pressure on that 10-year yield, which I think is probably not appropriate. The Fed can't do it, and despite discussions from Scott Bessent, there's an absolute limit as to what he can do unless that deficit comes in.
Okay, let's talk about that. He actually came out, and he had made a lot of noise before he became Treasury Secretary about Janet Yellen and her issuing more on the front end as being a liability and not terming it out. Then he came out and he said that he was going to keep that schedule of issuance, and the market rallied because there was a sense that he was sensitive to how issuance would end up affecting bond yields. Why do you think that's not enough at a time when that seemed to be the biggest concern for people?
Well, I think it shouldn't be the biggest concern for people. That's number one, because actually what should be the biggest concern for people is the sheer quantum of the U.S. fiscal deficit, which is enormous. And if we get any piece of the additional tax cuts which President Trump promised on the campaign trail, that deficit is set to expand further. And I see so little appetite for doing anything on what needs to be done to constrain that deficit, which would be on significant pieces of expenditure. And I'm not talking about DOGE here, I'm talking about the stuff, entitlements. That's the bottom line. We're looking at twice the level of expenditure here in the US that, in terms of the deficit that we had pre-COVID. And most of that's coming from entitlement spending. So, no, I don't think that it was purely a supply issue which was driving those yields up and down.
Given the deficit as a restraint, do you think that we only get an extension of TCJA then and none of the extras that Trump did promise on the campaign trail?
That's a really tough call because he hasn't talked as much on taxes as he's spoken on everything else, which we wish he wouldn't keep speaking about in terms of tariffs and so on and so forth. But he hasn't spoken as much. However, I think a week or 10 days ago, he did raise the idea of full depreciation of CapEx within the first year. Now, clearly that is unlikely to happen, but even a further reduction in the amount of time that CapEx can be depreciated, I think would be viewed as a positive, in part because nobody would see it as truly permanent. So you could see an immediate reaction of firms stepping in to do planned CapEx. It happened last time around because there's no true belief that under a different administration, some of these benefits wouldn't be taken away. So, yeah, I think some of them directionally probably have to happen beyond that main piece.
Some people have been surprised by the sequencing. They might also have been surprised by how other countries have responded to this, specifically Germany. Germany and Europe are about to go on a spending spree. An unexpected spending spree. How has that changed your outlook for fixed income?
So here's the thing. I think maybe a dozen years from now, we're all going to look back and say, OK, so the last fiscal non-reprobate standing was pushed down, and we all cheered. Germany was literally the only country amongst the developed, advanced economies which wasn't spending as if it was going out of style. Here's the thing. Mechanically, yes, growth goes up, but the multiplier attached to defense spending is incredibly small. So it's not as if this is going to trigger a wave of structural reform, innovation, which puts Germany onto this incredibly better growth path into the, indefinite future, which is what you'd want to see. The last thing is, I think it's highly unlikely that we're going to see it just actually being able to absorb those funds into the German economy or any other economy. It's not the flick of a switch. You can't suddenly ask Porsche to start making tanks. It doesn't happen that quickly, is all. I just think these things take time. So some of what we've seen in the reaction of the market seems to be somewhat overdone.
We don't want Porsche building tanks. Sonal Desai, Franklin Templeton. Sonal, not buying the happy talk out of Germany. Thank you. Up next on the programme in the third hour of Bloomberg Surveillance, Yoder of JPMorgan and more.
The key word we keep hearing is the word uncertainty.
You still have a lot of uncertainty out there, even after April 2nd.
There is some wait and see out there.
As we get more clarity, I think markets will be able to get on with whatever is the destination.
The next couple of months is going to be a really rocky road.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your equity market open is 19 minutes away and your scores look like this on the S&P 500. Positive by 0.25% and looking to build on a two-day winning streak. On the Nasdaq 100, we're positive by 0.2%. The next stop for this market, the economic data later this morning. Consumer confidence at 10 a.m. Eastern Time. How is the consumer feeling about this moment? KB Homes is attempting to answer that question. A downside surprise on Q1 earnings on the top and bottom line, and a cut to the outlook. That stock down this morning by 8%.
And how much does this have to do with what we're seeing with respect to tariff uncertainty and just policy noise in general? And how much was this pre-existing heading into this period of time? When it comes to the home industry in particular, housing unaffordability has surged to record highs. You've seen this decline relative to the rest of the market in home builders. This goes to Neil Dutta's point. How much of this was already in the works before all of the noise around tariffs really took hold?
And then layering on top, we've got all the tariffs as well. The president in the last 24 hours teasing a lighter touch on tariffs on April 2nd.
It sounds like he's going to be flexible when it comes to a lot of these negotiations. And already we see a flurry of diplomacy happening at this moment. Today, the European Union trade representative going to Washington, D.C., sitting down with USTRs, Jamieson Greer and Howard Lutnick, the Commerce Secretary. A delegation going to India. We know India is desperate to make potentially these concessions before next week. And then a phone call between Jamieson Greer and his Chinese counterpart. So you see, ahead of April 2nd, Trump is in negotiating mode, and I think he wants to get deals done.
The best thing that could come out of this a little bit later on this afternoon, following that meeting between the EU, the Commerce Secretary, and the US Trade Representative, some kind of agreement on autos. Just avoid all of this altogether, drop your tariffs, make sure they're equal playing field, move on.
How likely do you think that is? I mean, given the animosity that's rising.
We've seen the reports in the last week of potentially the Europeans making that offer, so let's see.
If that becomes on the table, how much does that allow this market to rip that much more at a time where people say that the momentum really is shifting back to the United States, and you are seeing economic data turn more favorable when you look at some of the surprises?
We said it earlier on this morning, it's difficult to read the tea leaves down in Washington, D.C., but I think an appreciation for some of the legal constraints on what this administration can and can't do on April 2nd starting to come to the surface.
Well, that's what the FT is talking about, this two-tier approach. What can they maybe do legally with, say, a national security law to enact tariffs on day one on April 2nd? And then what do they need weeks or months to do when it comes to, say, Section 301, which we know they used in Trump 1.0 for the Phase 1 trade deal with China? So that's why potentially April 2nd we'll have clarity on what might be enacted immediately and what might take longer.
Equity futures this morning positive by 0.25% on the S&P. Coming up through the next 60 minutes or so, Abby Yoder of JPMorgan Private Bank as stocks look to add to a two-day rally. David George of Baird on recent upgrades for U.S. financials. And Joe Davis of Vanguard on why he's lowering his GDP forecast for the rest of the year. We begin this hour with stocks steady following back-to-back gains on the S&P 500. Abby Yoder of JPMorgan Private Bank writing markets have quickly repriced to reflect increased risk related to tariffs and fiscal austerity. We still favour the US over the rest of the world and maintain our preference for software, industrials, utilities and financials. Abby joins us now for more. Abby, good morning.
Good morning.
Good to see you. Where does that view come from? Let's build on that. The United States over the rest of the world, because we have seen some significant underperformance in the first few months of the year.
Yeah, and I mean, I think a lot of that was positioning related, right? Like you come into if you think about the backdrop of coming into this year, that was general consensus that it was, US over the rest of the world. And that was reflected in valuations, right? Valuations in Europe were a 40% discount to the S&P 500. Typically, that's like 20 to 25% discount. So it didn't take much to get it to move the needle in terms of the outperformance, right? And you saw a lot of money flow over to Europe and China. And what hasn't happened is you haven't seen a fundamental re-rating in terms of those markets, right? So that makes them a little bit more susceptible to a pullback like what we're seeing right now because it was valuation.
Do you think they're vulnerable to the tariff announcements of the next few weeks?
Well, that's the thing. I think this was pricing in a lot of the good stuff, right? Like a lot of the German fiscal expansion. And, we were getting slightly better earnings in the region, more of like a bottoming out than I would say an acceleration. And it wasn't factoring in, I think, any of the negatives as it relates to tariffs.
You think April 2nd is peak policy uncertainty. But what about the questions that remain after April 2nd?
Yeah.
Potentially if Trump still wants to be in negotiating mode. How do you think about how long-term to look at tariffs if uncertainty is going to be pervasive for 4 years?
Yeah, I mean, I think I think there's a scope for it to be peak policy uncertainty because obviously we're going to get incremental information. And right now I think it's just everyone's kind of operating with a blindfold in terms of the headlines each day. But what I think will be important on that day is, one, obviously the scope and the magnitude, but also the duration. Like if we get any clarity around that, I think that will be very important in terms of markets digesting.
How do you think the Fed is looking at this? Because yesterday Raphael Bostic didn't like the word transitory when it comes to the inflationary impact potentially of tariffs.
I mean, we do view it as transitory in terms of the way that we have it in our economic projections, right? We have a one-step increase in terms of, this year and next year. It's just 10 basis points. And I think history would show, if you go back to 2018, that there wasn't really, an inflationary impulse. I think the way the Fed is thinking about it, at least as it relates to Powell, was really on the growth side, right? Like he seemed much more concerned or be willing to act as it relates to if there were a growth downturn. The bad part of that is that would take more pain in the hard data, which would probably feed through into equity markets before you see an action.
The areas that you like, I think, are really interesting. Industrials, utilities, financials, and software. Software makes sense. When you look at financials, they've taken a real hit, although they have recovered recently. And part of it is that deal making just has fallen off a cliff. There was some data that was highlighted in the Financial Times showing that the number of deals announced since the start of January is the lowest in more than a decade. How do you reconcile that with a bullish call on financials?
Well, so no, it's tough, right? Because it was a different outlook. When we wrote our outlook in November, it was a very different setup in terms of we were thinking this was going to be very much like Trump 1.0, where there was going to be pro-growth policies that were, first enacted. Now, I don't think that those things are changing. I don't think that, the dismantling dismantling of bureaucracy or, taking down regulation is off the table at all. I think there's just a different prioritization at the moment. And you're hearing that from a lot of banks, right? You're hearing that the pipeline is still there. We've gotten some announcements over the past couple of days and weeks that bode well for, I would say, the IPO market. And trading is doing quite well, particularly equity trading. So there are still things that could happen. And the deregulation is for the banks themselves, but also for, the prospect of loan growth going forward in the U.S. to other industries.
One of the reasons why this is such a hard moment is that markets seem to be swayed in such massive form, depending on the headlines. And yet there's some underpinning stories that are moving around other aspects of the market. And when you look at industrials and utilities, I have to wonder how much you're watching what's going on in China. Some of the pronouncements out of Alibaba and questions around how much people have wagered on these sectors getting a boost from the build out of chip centers that might prove to be maybe a little bit more ambitious than people previously thought.
Yeah, that's certainly a risk, but I think you saw that reflected in the pullback that you saw, right? These are some of the names that were down in excess of 20%, right? Well in excess of the market. And I think when it comes to utilities specifically, right, there's regulated, there's, independent power producers within that index, and it's still overall a defensive index, right, or a defensive sector. And when you're thinking about the other options like a healthcare or a staples who have re-rated 5 to 8% this year, I mean, it still screens as the most attractive defensive, and it's domestic in nature, right? So keeping that in mind as well.
Where are you on some of the consumer-facing companies? Because we heard from Delta Airlines in the last few weeks that things weren't great in Q1. In the middle of February, we're hearing from KB Homes overnight that things aren't tremendous as we start to kick off selling season. Where are we for the consumer now?
So I think there's some choppiness as it relates to seasonals that are going on in January, February. You've heard a lot of comments around weather and, weather-related choppiness. And there's also just, from a company standpoint, like there are market share losers. And I think those gain the headlines a lot of the time in terms of like how they did in the quarter and then their projections going forward. Overall, yes, I think the consumer is softening. We had that in our projections. It's just a matter of how much they're slowing. But that did result in us taking down, our 2025 numbers just 3% to start the year, or in the past couple of weeks.
So are you pretty much ignoring the consumer confidence data that we're going to get in about 2 hours' time?
Not ignoring it, no. But, having to, like you said, though, there's idiosyncratic things that are going on underneath. And I think, like, for example, airlines are struggling, but cruise lines are doing fine, right? So you have to be very specific in terms of your consumer exposure.
We saw it with one company in the past week. Elisa's asking the right question, though. How much weight do you put on that data point now? Is there a reduced weight on that data point following what we heard from Chairman Powell last week, who doesn't seem to be putting much weight on it at all?
I mean, I don't think that you can just take it at face value and ignore it, right? Like there is a message being sent, and I think that's exactly what this administration is addressing. In terms of like, we can't necessarily call it a vibe session. It might be, we're 2 years into this Fed hiking cycle, and there are real ramifications for higher rates. And so I think just, being cognizant of that risk is something that we're definitely focused on.
The Treasury Secretary himself made that point in the last week.
Yeah, this is going to be something that's really important. You know what keeps striking me, especially with Sonal Desai and then the discussion around tariffs and how that's affected the stock market. Stock market's focused on tariffs. The bond market is focused on the debt negotiations and what happens in Washington, D.C. getting passed. And I find it interesting to see these two different tracks and kind of where they meet and where they don't. Anyway, my thought of the moment.
Abby, it's good to see you.
Thank you.
Thanks for catching up with us. Thank you. And thanks for tolerating Lisa for a little bit as well. Abby Yoder of JPMorgan Private Bank, thank you. No, I'm with you. You make a really good point. It's a couple of different things this market is focused on right now.
Honestly, you can apologize, like evergreen apology to everyone who watches.
I'm agreeing with you. Equity futures here up by 0.2% on the S&P with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Trump's tax bill is taking center stage on Capitol Hill today. Sources tell us that Treasury Secretary Scott Bessent, National Economic Council Director Kevin Hassett, House Speaker Mike Johnson, and Senate Majority Leader John Thune will all meet to discuss the reconciliation bill. The Trump administration is extending Chevron's deadline to stop its operations in Venezuela. The Treasury Department says that the oil giant now has until May 27th to stop operations. Chevron is the only U.S. oil company that's still in Venezuela. It produces about 1/5 of the country's crude output. And in the NCAA tournament, the Sweet 16 in the women's tournament is set in a double overtime thriller. Maryland beat Alabama. UConn cruised past South Dakota State. Texas took down Illinois, and USC flew past Mississippi State despite a season-ending injury to star Juju Watkins. Oklahoma also advances to their first Sweet 16 since 2013. And that's your brief, John.
Hey, Danny, thank you. Just looking at the brackets and the scores on the Bloomberg terminal. Annmarie still crushing it.
I'm
Good
sixth
news.
globally.
Amazing.
Third for the firm. Now beating Mark Rowan.
Are you beating Michael Bloomberg?
I am beating Michael Bloomberg.
By how many points?
He's 101. I'm 106 by 5 points.
I'm looking at our charity league as well. Jim Zelter of Apollo, top of the pile, beating Mark Rowan of Apollo.
But I'm beating all of them.
By just 2 points.
Is that allowed? Is it going to be internally sanctioned?
I'm not sure what kind of fight's happening over Apollo, over the Women's March Madness. We'll find out. I think Jim's joining us in a few weeks. So we'll find out from Jim in the next week or so. Up next on the programme, the Morning Calls plus David George of Baird on his upgrade of certain US financials. That conversation just around the corner, live from New York. This is Bloomberg. The opening about 1 hour and 15 minutes away. Equities doing okay, up by 0.2% on the S&P 500. On the Nasdaq, up by 0.2% also. Later on this morning, in 1 hour and 45 minutes time, consumer confidence in America. Another read on how the consumer feels about this economy. That's going to be an important one. And then later, Fed speak. The New York Fed President, John Williams. How much daylight is there between him and Chairman Powell following Chairman Powell's news conference last week? I don't think anyone's anticipating daylight between those two, but certainly daylight between him and what we heard from Raphael Bostic yesterday.
Can New York Fed Chair John Williams say the T word? That's my big question, because what we heard from Raphael Bostic was he wasn't even going to say the word. Absolutely not. That was not in his base case. If we get the same kind of T word, does that give hope to the market?
We've seen Williams do a clean-up act for Chairman Powell before, following a news conference, haven't we?
You think that transitory is a clean-up act?
I don't know. I just don't know if he meant to say that. I really don't. It felt deliberate. I'm with you. It felt deliberate. It just seems clumsy. Why bother? Why go there? There's better ways to describe the moment.
Why bring that back? What is the goal other than to message to, frankly, the political sphere that they kind of are watching this and taking their word for how this trajectory is going to be? So don't blame us and don't come target us. And how much is this trying to buy them some political space?
Look out for those comments from the New York Fed President John Williams a little bit later on this morning. Let's get you some morning calls. First up, Baird cutting its price target on Airbnb to 160, seeing short-term rentals stabilising. That stock is up by 0.1%. Your second call from Morgan Stanley, upgrading Carvana to overweight, pointing to competitive advantages and an attractive entry point. That stock is up by 5.5%. And your third and final call, BTIG upgrading Capital One to buy, citing positivity around the bank's potential merger with Discover. That stock is up by 1.3%. Let's stick with the financials. David George of Baird upgrading banks, including Capital One, JPMorgan and Bank of America. David writing, tariffs won't have a direct impact on the sector, but obviously can drive fears around credit quality and revenue growth slowing. David joins us now for more. David, welcome back to the programme. Been meaning to catch up with you, sir. Appreciate the update on some of the calls. So let's start with Capital One. Let's start there because that's been in the headlines in a big way over the past few weeks. David, what do you like about that franchise at the moment?
Yeah, good morning, John. From our perspective, the weakness over the last 2 to 3 weeks around, as you mentioned, tariffs and uncertainty around policy has created an opportunity in a number of stocks, Capital One being one of them. And with the stock getting to kind of the 165 area, we felt like on a risk reward basis, the stock was very, very compelling. And in our opinion, the Capital One Discover deal, if it goes through, is a transformative deal with significant cost synergies in addition to revenue synergies over time by enabling Capital One to put a number of its cards on the Discover network. There's a significant revenue upside potential from our perspective that is not reflected in the stock at current prices. And we think kind of on a normalized basis, Capital One can earn at least $22 to $23 a share once the deal is closed in 2027. And this is a deal that will not only result in significant synergies, we think the profitability of Cap One post-close is going to improve by 20 to 25% as well. So this is, we think, one of the better ideas in the financial space and in what we think is going to be a transformative deal.
Can we address the if, David, if it closes, if it goes through? Sure. How much of your buy on that name hinges on that if?
It's a big part of it, John. Clearly, as I mentioned, this is a very transformative deal strategically and economically. If the deal weren't to go through, we felt like at 165 or so, the downside was fairly limited. We think Cap One as a standalone company can earn $16 to $17 a share and is in currently a very enviable capital position today, and credit is holding up relatively well also. So if the deal were to not go through, to be clear, Cap One is definitely vulnerable to the downside, but we think the upside potential offsets that potential downside risk that you mentioned as it relates to this Discover deal. But we should get some clarity, hopefully, over the next several weeks.
David, how much is this really a litmus test for the Trump administration's openness to some of the bank tie-ups that a lot of people have been hoping for?
Yeah, it is a big litmus test, Lisa, as you mentioned, and there's obviously, as you mentioned with your earlier guest, a lot of optimism around M&A broadly. We've seen a slowdown in the last month or two, given the uncertainty around tariffs. The M&A business at a number of the companies we cover, the updates have been softer, and that's a result, we think, of some of this uncertainty around tariffs. So this is a big litmus test, and we're of the view that we are on the cusp of a big bank M&A wave. We wrote a piece on that over the last month or so, and we think there's going to be a number of deals in the regional bank area over the next couple of years. And we think that we're of the view that this Cap One Discover deal is going to go through. But as you mentioned, this is a huge litmus test on this new administration, their views towards bank merger activity.
This was raised even more so last week when there were reports the Department of Justice under President Trump were taking a second look at this deal because it created an unfair playing ground or took away a competitive landscape for particularly credit cards to lower income consumers. Do you just dismiss those reports as being noise, or are there other elements that you have heard out of this administration and, frankly, the FTC under Trump that make you think that actually this could be the road ahead?
No, we obviously read the reports, Lisa, last week that I think it was Capital Forum talked about the subprime concentration. It's important to know we don't cover Discover, but if you look at their balance sheet, Lisa, they've only got about $1 billion in subprime assets. So in a worst case scenario, if Cap One needed to sell those, it would be very negligible from an earnings impact to the extent that they had to dispose of that asset. What wasn't discussed in all of the concerns around this deal is that Discover is currently under some regulatory scrutiny. They're under regulatory supervisory issues today, and closing of this deal would eliminate that. So we think that this solves a regulatory problem, and that offsets any potential risks as it relates to the subprime issue you mentioned.
On a larger level, David, a lot of people came into this year thinking that we could see tie-ups between smaller and mid-sized banks, and that this would be the time and the political climate to do it in. So far, we have seen the number of deals announced year to date fall to the lowest in more than a decade, this according to a Financial Times report. And a lot of people are saying these deals are just iced. They're not necessarily benched completely. At what point would you change your view, your optimism that there could be some potential wave of mergers and acquisitions in the financial space? At what point in the year?
Yeah, I think that's right. I would say, Lisa, 3 to 6 months. I don't think this is going to take very long. It's important to note that we're just getting folks in their chairs. Michelle Bowman obviously was just named to and needs to be confirmed from a supervisory perspective. So I think we need to get some of the new people in their seats before we can really say that this administration is not pro M&A. So from my standpoint, at least, this is something that I think we need to give a little bit of time. And I think 3 to 6 months is more than reasonable.
David, of the banks on Wall Street, just before you go, top pick right now, is it still Bank of America?
So our top picks here, from our perspective, John, would be Cap One, as we obviously talked about. In the mega cap space, Bank of America is one that we recently upgraded. In the 6 stocks we upgraded in the teeth of the sell-off. B of A, there's been a lot of angst around Berkshire Hathaway's ownership in the stock. And as you both know, they've been selling the stock over the last several months. And we think that is really just to get under the 9% threshold so they don't have to report on it as frequently. And we're of the view that this provides an opportunity, particularly when the stock got in the low 40s. We think about Bank of America as a $48 to $50 stock, and that's kind of 10 times what we think a normalized earnings power for B of A would be in that $4.80 to $5 region. So B of A, we think, looks really good and is our favorite mega cap name right here.
Outperform rating, $50 price target. David, appreciate your time, sir. It's good to catch up. It's been too long. David George there of Baird on the US financials. Pleased you went there on M&A and capital markets activity. Clearly, things haven't developed in the way people thought they would. Is it delayed or derailed? I think a lot of people still assume it's just delayed and not derailed. But if you go through the reasons why at the moment, market volatility, antitrust concerns, 1 and 2 weighing on 3, CEO confidence. Now, you can do something about market volatility, maybe that fate in the next several months. Maybe that contributes to better confidence levels for the C-suite. But antitrust concerns, I think we've still got to work through them. Based on what we've heard so far, there's almost a continuation of what we saw in the Biden administration into the Trump administration. And this is something you warned about repeatedly before the election.
That's because when it comes to the individuals surrounding Trump, there's a lot of populist thinking when it comes to antitrust. And you have to think of what J.D. Vance said about the Biden administration. You cannot overemphasize the one person he thought was doing a decent job was Lina Khan. So that is why you see some of this continuation, especially when it comes to big tech. But that already started in Trump 1.0.
If you're just joining us, welcome to the programme. Equity futures here positive by 0.2% on the S&P. Later on this morning, consumer confidence at 10 a.m. Eastern time. Joining us to discuss, Joe Davis of Vanguard and Krishna Memani of Lafayette College. Live from New York, you're watching Bloomberg Surveillance. $60 minutes away from the opening bell. Equity futures here positive and near session highs, up by 0.25%. Let's get to your morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. It's a tough pre-market session from the home builders this morning, and that's because of KB Home. It's off of the lows of its pre-market session, up down nearly 6%. It missed on the first quarter and cut its 2025 outlook, saying that the spring season demand has gotten off to a slow start. There's affordability issues with consumers, and that macro and geopolitical uncertainty means people are holding back on purchases. Now, to the upside, we have Cloudflare this morning, the technology company, up 6%. A rare double upgrade from Bank of America, who says that it has a differentiated AI product. It goes from a $60 price target to an $100 60 price target. That is a big upgrade. Finally, rounding things off with some earnings this morning, McCormick, this is the spice maker. Their sales were flat. That is a miss versus expectations, so they're down more than 3%. The interesting thing was the commentary about tariffs here, though. They said, like so many companies, they're not including it in its 2025 outlook because of the uncertainty, but it does say, John, what price increases it might see. It plans to offset those by cost cuts and, importantly, price adjustments, suggesting that McCormick plans to pass those prices on to the consumer.
Danny, thank you. Earnings season's going to be a big deal. Ramps up with the banks on Wall Street in a few weeks' time. Lisa, JPMorgan on April 11th.
What do they do with their outlooks? We were talking about whether they withdraw them altogether because there is such little clarity. Right now, we have heard from a number of retailers that have been lowering their expectations for the full year just based on what they know about tariffs. They're going to have more clarity when earnings season kicks off.
Got an update from Dowson in the past few weeks. They'll report a fuller earnings package on April 10th. So look out for earnings in a few weeks' time. Stay side. We need to look out for the economic data later on this morning. US consumer data due at 10 a.m. Eastern time. And Michael McKee has more. Good morning, Mike.
Good morning, John. Well, the consumer confidence data that we've had from the University of Michigan and the Conference Board have disappointed and raised red flags about the possibility of an economic slowdown. We get an update on the Conference Board numbers today that, according to economists, will put us into territory we haven't seen since the height of COVID. January of 2021. If the blue line there falls as far as we think today to 94, it's really going to be another signal that consumers are getting very, very nervous. Now, of course, you've been talking all morning about watching what they do, not what they say, but it is going to be very interesting to see what they have to say about their buying plans, which is a big part of the consumer confidence survey from the Conference Board. We also get new home sales, but they're only for February. You saw Danny talking about home builder shares. This isn't going to help one way or another because it was during a month that was very cold. We might see a slight rise, but it isn't going to tell anything about the spring selling season. And I'll pass along this one number here, only because it's one of those catch your eye numbers. The Philadelphia Fed, we talk about their manufacturing index. They have a non-manufacturing index that was just out. It fell from negative 13.1 to negative 32.5. We don't have a long history with that. Can't tell you exactly what it's going to mean in the long run, but it does show on the business side a big lack of confidence.
The data gets murkier. Mike McKee, appreciate the update. Expect more from Mike throughout this morning, particularly on consumer confidence from the Conference Board. Getting an understanding about anxiety around the labour market, I think, is going to be tremendously important as well. If you're worried about the second round effect of tariffs passing on higher inflation, that's got to be key.
And we did hear notes of that within the University of Michigan sentiment survey. Say what you will about its accuracy or its survey methodology, but people did cite their concern about that. You also look at the quits rate. That's going to take on a bigger import than, say, even the JOLTS number, because that will give you a sense of how much confidence people have to quit their jobs and move on.
We've seen a lot of downgrades to economic growth, including from JPMorgan and Goldman Sachs. Vanguard is now slashing its 2025 GDP forecast. Joe Davis of Vanguard writing, uncertainty around tariffs, immigration and other policy is likely to weigh on growth in 2025. Real-time signals point to a material slowdown in GDP growth in the first quarter. Joe joins us now for more. Joe, welcome to the programme. It's good to see you. So set us up. How did you come into 2025? What kind of numbers were you anticipating and what are you looking for now?
Well, we were closer to trend going into the year. And again, that was clearly a downshift from the strong performance we saw in the U.S. in 2024. So we were assuming some tariff legislation would pass. It's been more of the uncertainty around policy that has crimped our forecast from the investment side and from some of the consumption side. And so I think you're seeing that in other parts of the market. So it's really the uncertainty tax that's led to a more significant downgrade, at least in the next several months.
Joe, a number of guests have come on the show and said so far the uncertainty tax could be easily reversible, and that if there is some certainty imbued into markets, that would go away and the deal activity would come roaring back. Do you disagree?
I don't disagree. Again, it's what history shows is that uncertainty, although very unpleasant, does have a half-life, and it will start to fall in part because of the second round effects, and you'll have financial volatility, and potentially that'll affect policymaking decisions. But we're in for some turbulence here. I think we've seen that in the financial markets. We've seen that in some of the soft data. We're going to see that a little bit in the hard data. But again, we do not have, to be clear, we do not have recession as a baseline. I think it's going to be important for investors to really dissect the signal from the noise. It's clearly a downshift, but I do not see that dropping below zero for the next 6 months.
Raphael Bostic yesterday sitting down with Mike McKee talked about when he goes out to businesses, two things they've told him. One, they see business having an uptick, but at the same time, they also think they need to raise prices. And he says the biggest question for 2025 is how consumers manage through those price levels. Do you think consumers are able to deal with higher elevated prices?
Well, I think it's really bifurcated just consumer market. We have, some with lower incomes, which are really going to struggle. They were already on a weaker footing going into 2025, and I think that will continue given the stagflationary impulse. The higher end consumer really will depend on the strength of the labor market, middle income, higher income, which has really been the strength of consumption over the past 12 to 18 months. Again, given our baseline, we're going to have turbulence here, but we do not have a recession. That would be the high-end consumption and businesses rolling over in the labor market. That's just not our current forecast.
Joe, how much do you take a look at the soft data and factor that into your expectations going forward at a time where a lot of people have been saying, well, it's unclear whether that actually will trickle out into what we see from the government?
Well, I think it's important to look at all data. I mean, hard data is a little bit more tangible by definition than soft data, but soft data is not worthless. I think it also speaks to sentiment, which again, you have to overlay just the uncertainty itself, which there's quantified measures of something that seems esoteric. So I think you look at all of them, and that's pointing to softness for sure. But it's also not pointing to that we are going into a significant recession. At least that's not in the data right now. So that's where the next 3 months are really important from a market and economic perspective.
There's been an interesting shift in psychology over the past 2 months. Heading into this year, people expected that tariff announcements would hurt the rest of the world more than it would hurt the United States. And right now, the rest of the world seems to be shrugging off some of the tariff threats coming from the United States. And investors seem to be suggesting that the U.S. will experience the greatest amount of pain. Do you agree with that from an economic perspective, that the U.S. may shoulder a greater proportion of any kind of slowdown in the economy from tariffs than, say, Europe and China?
Well, not necessarily. I mean, again, I think if you look at all countries, obviously, if you were talking about tariffs on autos for Canada and Mexico, given the integrated supply chain, there would be a significant hit to those economies. For Germany, again, you have cross currents going on in the global economy, both right now and for the next year or so. You have the focus on deficits, you have the government spending. We're seeing that different dynamic in the U.S. versus, say, Germany. And then you just have this greater competition between the U.S. and China, and the desire for the U.S. to have a little bit more manufacturing here at home. So all of these forces are coming at the front at the same time. And so you're going to go through turbulence just because of those intersection of those forces.
And the Fed has got to attempt to navigate all of that, Joe. So let's finish there. In the next 20 minutes or so, we'll hear from two core members of the Federal Reserve, one, Governor Kugler, in the next couple of minutes. And then shortly after 9 a.m. local time, 9 a.m. Eastern time, we'll hear from the New York Fed President, John Williams. Joe, I just want you to reflect on what we heard from Chairman Powell last Wednesday and whether it led to you asking any questions about the incoming Fed speak, what you'd like to hear, where you think maybe there were some spaces that they need to fill.
I think they are wait and see and risk management. I would be also, which I was happy to see, not in an urge or a rush to cut rates, because you do have the stagflationary impulse, and we're just off of 3 years of inflation well above target. So I think they're being prudent here. I think they are worried about some weakness in the labor market should it emanate, and so I think they're prudent in doing a wait and see approach.
They're very much in a wait-and-see mode. Joe Davis there of Vanguard on the Federal Reserve. More Fed speak, Lisa, coming up through the next 20 minutes or so.
I want to know whether they think transitory is still in effect. I want to know the T word. Will they say it? Say transitory. Just say it. No, I won't say it.
Is that what you want them to say?
Well, this is what I think is most interesting.
Do you really want to play that game again?
Well, honestly, this is where we're going. I mean, the fact that Raphael Bostic wouldn't even say it tells you a lot about where he is. And given the fact that T-word has real power over this market, because let me tell you, people took that and they ran with it. And that's, I think, really what people took away from that news conference.
It was a really interesting exchange with Michael McKee and the Atlanta Fed president just yesterday. Mike, just to bring you back into the conversation, there are other Fed officials we're focused on this morning.
Yeah, Anita Kugler just out with headlines speaking to the Hispanic Chamber of Commerce, suggesting that she is watching the consumer sentiment numbers closely, particularly for inflation expectations. She said she's paying close attention to the acceleration of price increases and higher inflation expectations, especially given the recent bout of inflation in the past few years. She's tying it back basically to the fact that consumers are probably going to be hit with the tariffs. And that is something that the companies who are talking to the Fed people are telling them is going to happen. They're just going to pass it right along. She notes that inflation in some categories is going up again, and goods inflation has accelerated. So she's a little bit worried about what might happen, and that's going to put some downward pressure on the idea of 2 rate cuts. John Williams coming up top of the hour, but it's opening remarks at a banking conference. I wouldn't expect too much from him. But as these Fed officials come out, we are seeing much more caution on their part.
Interesting. Mike, thank you, sir. Michael McKee with the latest on the Fed speak coming from Fed officials in the past few days and what you can anticipate for the next 20 minutes or so. With us around the table, Krishna Memani of Lafayette College. Krishna, good morning. Good to see you.
Good morning.
I want to reflect on what you said last time, back in February. You said you'd rather be in bonds than stocks. Since then, stocks are down. Bond yields are lower. You're still in that position.
I think so. If you kind of evaluate the situation right now, the risk of the economy accelerating with all sorts of things hanging over the economy is pretty small. On the other hand, there's a real possibility that we slow down. So in that environment, being in stocks or being overweight stocks relative to bonds, I don't think makes much sense.
Especially because you say 5,600 is the new 6,100 on stocks. And that's a pretty bearish outlook, considering that most people on the street are seeing 6,000 or above as the likely target for year end.
Well, so the point I'm trying to make is we have a new trading range. We are not going back to all-time high. And if we do go back to all-time high, we are not staying there. I think given the level of uncertainty that you have in the market, expecting the same valuation on tech stocks that you had before that uncertainty, I think doesn't make any sense. If earnings growth was going to accelerate, then that would be a different issue. That's not the case anymore. So the point I'm trying to make is get used to a lower trading level. It's not the end of the world. It's down, let's say, 5, 7, 10% point from all-time highs. It's a decent level.
You know, it seems as though the uncertainty tax around tariffs affects stocks. It seems like bond markets don't care. It feels like on the margins, maybe high yield bonds and maybe some of the spread market credit. But when it comes to government debt, it's sort of almost a comfort. It can kind of suppress growth a little bit, potentially down the line. They're paying attention to the budget. Do you think that that's the right way to look at it?
Well, so they're not paying attention today. And the reason they are not paying attention today is because there's enough momentum in the economy to continue to sustain the growth level that, as Joe was saying, he's not looking for a recession. He's looking for sub 2% type growth rate, which is pretty decent given inflation level. 4% on 10 years makes a lot of sense. However, if things slow down, if this continues and this continues till the end of the year, I think things will slow down. Things will slow down on all fronts, consumption and investment, and therefore bond markets will probably react at that point. I think the other thing to remember in this context is bond markets are going to react far earlier than the Fed. Fed is out of the picture for all practical purposes because of inflation. They can talk transitory, whatever. They're not cutting anything, and but they're not raising rates as well. So they're completely out of the picture. And the move will be on the bond market's court to see if the economy has slowed down enough where stagflationary issues that they're worried about today kind of fade away. We are talking about slow growth and a potential recession. Not today. Towards the end of the year.
This is key. Let me pick up on that. Last week, not hiking was bullish. I want to understand when not cutting is bearish. That's when the story starts to change, because what they've communicated to us is that they've lowered their growth expectations but haven't added to cuts. Now, the market ignored that because the market focused on, I get it, they're not hiking, that's bullish. When do we get to a point when the story starts to change?
Well, so I think you have to see potential slowdown in the economy. And I think you're seeing signs of that, but the momentum is enough for us to kind of continue down this path for at least a few more quarters. So if you see any of that, that's probably coming at the tail end of this year rather than middle of this year.
What do you think would convince people it's here? It wasn't Delta Airlines, it's not KB Homes, it's not the sentiment surveys. What do we need to see?
Employment. At the end of the day, what drives consumption drives the economy, and what drives consumption is employment and income growth. If you see significant slowdown in both those fronts, I think the bond market would have its day.
Regardless, you are still more bullish on bonds than stocks, correct?
Yes. Yeah. Again, I'm not bullish on stocks. I think right now we are in a trading range. But if I had to put $1, I would probably put it in bond market rather than equities at this point.
So is it this idea that you are going to see some sort of deceleration in growth that you're expecting and actually a big rally into the bond market, or is it just a hiding spot? It's a distinction.
Oh, absolutely. If it was just a hiding spot, you would be rather in cash than bonds. So, because you earn comparable yields. So it's really about the expectation that with the level, given where we are in the cycle, and given the kind of kneecapping that we are going through from a policy standpoint, I mean, that raises the risk of a potential slowdown quite meaningfully. And that's the reason to be in bonds rather than equities.
April 4th, the next payrolls report. It's going to be the big one. Going to be waiting for that. And if it's weak, people will really think things are very weak.
And if it's strong, people will say, well, it's not being reflected yet in the data. So we're going to be on repeat with this story until we get some sort of concrete evidence one way or another.
That's where we are right now. Krishna, it's good to see you. It's great to catch up. Thank you, sir. Krishna Memani there of Lafayette College with an update on stories elsewhere. Let's get to your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Moments ago, the White House responding to Atlantic editor Jeffrey Goldberg, who says he was added to a signal text group where top U.S. officials discussed plans to bomb Houthi targets. Press Secretary Caroline Leavitt saying on X, quote, Goldberg is well known for his sensationalist spin. No war plans were discussed. No classified material was sent to the thread. Leavitt adding that the White House is looking into the incident. President Trump has issued an order allowing a 25% tariff on any country buying oil and gas from Venezuela. It cuts a major revenue source for Venezuela as the country's dispute over immigration. The tariff also puts pressure on China, which is a major purchaser of Venezuelan crude. Elsewhere, OpenAI is expanding the role of its chief operating officer, Brad Lightcap. He will now oversee day-to-day operations, including international expansion and partnerships with firms like Microsoft and Apple. The company's CEO, Sam Altman, is shifting his focus to the technical side, including guiding research and product efforts. And that's your brief. John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll head down to Washington, D.C. and catch up with Bloomberg's Tyler Kendall. A full schedule in the nation's capital, including some negotiations between the EU's top trade advisor and the United States. We'll get to that in just a moment. Live from New York, you're watching Bloomberg TV. Equities firmer here, up 0.25% on the S&P 500, up by 0.2 on the Nasdaq 100. Some things to look out for as we work our way towards the opening bell at 9:30 Eastern Time, about 39 minutes away. At 9 o'clock, you will hear from the New York Fed President John Williams. At 10 a.m., consumer confidence numbers. Later on this afternoon, 2 p.m., President Trump signing executive orders. Wednesday, durable goods. Thursday, GDP plus another round of jobless claims. And on Friday, core PCE and another read on the consumer, this time from UMich Consumer Sentiment, to close out the week. Elsewhere, high-level trade talks set to begin in Washington later on today. Bloomberg's Tyler Kendall joins us from the White House for more. Tyler, just how high stakes are these meetings taking place in the nation's capital this morning?
Incredibly high stakes, John, considering that the European Union has really been the focus of much criticism from this White House, whether that's on defense spending or getting to the negotiating table on trade. We know something tangible this White House would like to see is dropping tariff barriers when it comes to U.S. auto imports. But we also have to keep in mind these discussions are going to talk about those non-tariff barriers as well when it comes to value-added tax and digital services taxes. I'd also point out that later today there is going to be a big meeting between Treasury Secretary Scott Bessent and Republican congressional leaders about the way forward on the fiscal agenda, that tax cut plan. We are going to start to hear the rhetoric really dovetail about tariffs as a revenue raiser as they look ahead to that broader growth agenda that they are trying to push when it comes to the tax cuts.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C., outside of the White House. That should allow us to have a discussion about the fuller policy mix and not just one dimension, one element of it.
Exactly. Howard Lutnick, Jamieson Greer really taking the front foot when it comes to tariffs, which we're going to get at least some little bit of clarity next week. And then Scott Bessent and Kevin Hassett working with Congress to make sure that they can get this reconciliation bill, extend TCJA, and then maybe even more what the president promised on the campaign trail through Congress.
I want to understand the team of rivals and how much different people are pushing for different things and whether there actually is a cohesive plan that comes together with a clear directive. Right now, people are still wondering where the nodes are. Is it to raise revenues? Is it to rejigger trade alliances? Or is it to actually reduce tariffs with some sort of negotiation, particularly with the likes of the European Union?
They've thrown a lot against the wall, haven't they, in the last few months? I would just say this. A lot of indications in the past couple of days that Jamieson Greer, the US trade representative, has taken some control of the situation. I think some of the comments you've heard in the last 24 hours, including the reporting coming from the Financial Times earlier on this morning, an indication that there is a renewed, perhaps refreshed appreciation for the legal constraints around some of these issues going into April 2nd.
Well, he's the legal mind of all of this. He's a trade lawyer. He worked under Ambassador Lighthizer, who really was the genius, if you would say, behind Trump's tariffs, if you are on board with them in Trump 1.0. So he's looking at actually how do you do this legally so it doesn't end up in courts. And we've had reporting that he's been the one that wants to kind of rankle back some of this control. Notice he's having this meeting today as well with the Europeans. He's also getting on a call this week with his Chinese counterpart. So I think a lot more weight is being placed on him.
Getting a better understanding of the legal framework for how to deliver some of these policies, I think, gives you a better idea of what you might see and might not see in early April.
Which is the reason why people are expecting a several-phase type of inquiry where you get some that the president can place under IEPA, and then you have others that are going to be more of an inquiry. Again, it's not the end of uncertainty, but I love what Abby Yoder said. It's peak uncertainty just because then we have some details and we're not just completely blindfolded. So that's where we're at.
And once we get clarity, is that a good thing or a bad thing?
That remains to be seen, and I think it's an excellent point.
It's going to be big for the economic data. A little bit later on this morning, 10 a.m. Eastern Time, another read on US consumer confidence. And US consumer confidence, it's been heading in the wrong direction based on several surveys over the last few months. Will that change later on this morning at 10 a.m. Eastern Time when we get that data point? To react to it tomorrow, a fantastic lineup. We'll be catching up with Max Kettner of HSBC, who this morning downgraded US equities, high yield credit and investment grade credit to underweight. He joins us tomorrow morning. Don't miss that. We'll also catch up with Chris Ma of Ocean First Bank, Tony DeSpirito of BlackRock and Subhadra Rajappa of SocGen. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Magda Linette clinched her biggest win of the season as she took out number 3 seed Coco Gauff in straight sets to reach the quarterfinals. Linette taking full advantage of a poor performance from the American, who fired 12 double faults and 42 unforced errors in the loss.